mega cap tech just continues to crush it on basically every angle.
There's nothing wrong with tech. These companies have a ton of cash. It's just everybody's in love with them.
When you have these, powerful momentum stocks and growth rates decelerate, growth investors get angsty.
Earnings are earnings, and cash is cash. And so that is what people are looking at.
The Fed is in the rearview mirror. We're focused on other things. We are willing to trade rate cuts for earnings growth.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Bramo's back, alongside Anne-Marie's voice, kinda.
It's back.
It's back? Okay, good.
Fabulous.
From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance, wrapping up the month of April. With a month of losses potentially on the screen right now, the scores look like this. We're down more than 2% on the S&P for the month of April. The small caps have been absolutely hammered. Remember the end of March, the rotation, it's coming. Buy small caps, yeah, okay. Big downdraft for the small caps so far this month, snapping 5 straight months of gains for equities on the S&P 500. Bramo, April has been a bumpy ride.
And this is partly because that was the sound of the narrative breaking, or maybe the narrative shifting. And I think Max Kettner put it perfectly this morning of HSBC when he came out and basically said, higher inflation is fine for stocks, actually. It's fine for earnings. And oh yeah, if yields stay here, it's going to be okay. Everything is fine. And this is the new narrative because yields are high for the right reasons. Are they? And I think that that's kind of the angst that you're feeling in terms of what's playing out in the market.
We'll take a look at the bond market and we'll break up the yield curve from the 2-year out to the 10-year. On the month so far, the 2-year yield is higher by something like 35 basis points. The 10-year's up by more than 40. I remember a few conversations we had this month, just a few. One was Steve Rasciuto of Mizuho.
Yeah.
And Steve Rasciuto said this Federal Reserve wants to cut interest rates. Anne-Marie, he said this data is not cooperating, and this data so far this month hasn't cooperated.
It hasn't cooperated, which is why all the guests told us yesterday that this week's Fed meeting, today and tomorrow, is basically going to be a snooze fest. And why we just heard from Jay Pawlowski basically saying that he will take earnings growth, which we've had 80% now come in, beating estimates. He will take earnings growth over Fed cuts.
Tons of conversations this month about US exceptionalism. Just in the last 24 hours, I think that conversation shifted into the prospect of peak US exceptionalism. Take a look at the data overnight. China, better than expected. The top 4 Eurozone economies, so that's Germany, France, Italy, Spain, all beating expectations for first quarter GDP. Do you sense the tide is starting to turn just a little bit?
That the scenario over there is starting to rhyme with the scenario over here. That basically you got GDP coming in hotter than expected, and you had inflation just incrementally in Germany and in France coming in hotter than expected as well. Raises this question, does this give the ECB room to cut rates and be stronger? I was surprised we didn't see more of a reaction in the euro. I was thinking, wow, we could pop 108. I mean, this could be something that you could really see strength pop in.
It does beg the question, though, potentially this is going to be a huge tailwind into the ECB cutting rates in June. If their economies are already bouncing back, what I look at is, yes, of course, everyone's going to want to talk about Germany, right? Because they're the ones, they were the sick man of Europe. They're coming out of that at the moment. But really, it's the peripheral. It's Southern Europe that we've seen this bang coming out of the pandemic. And that has to do a lot with tourism and the fact that they weren't as reliant on Russian oil and gas. For years, they've been more dependent on renewables.
Just want to focus on China getting a little bit better as well. On the commodity market, things have really started to wake up. Big time. Copper back through 10K. Saw that in the LME in the last week. Saw it again yesterday. Iron ore heading for the biggest monthly gain since late 2022. This has been the turn we've started to see across commodity markets.
Can I just say the China factory activity data, so many people coming out and saying that that's a positive because that means that they're going to be able to hit their 5% goal. Talk about overcapacity and oversupply. It's all coming from the industrial side. A lot of economists saying they should put more money into this. Well, guess what that's going to do? This really raises this question. If you see basically their margins being crunched because the government's funding it and there isn't necessarily the demand, it just raises a lot of political questions.
Isn't that the disinflation the world needs, that Europe wants, that America wants? No?
Janet Yellen put it well. It's on sale and we're not saying thank you this time. And that's essentially where we're at.
Yeah, hello November. There's an election coming up. Equities right now on the S&P 500, negative 0.1%. We're pulling back on the S&P 500. Just a touch, down a lot more on the month so far. Yields are up by a single basis point on the 10-year, 462.40. Coming up on the programme, we'll catch up with Julian Emmanuel of Evercore ahead of Amazon earnings, former senior intelligence official Norman Rule on Israel-Hamas talks, and former Fed economist Claudia Sahm saying a strong economy should not delay delay rate cuts. That conversation later this hour. We begin with our top story. Corporate America beating expectations this earnings season. Bloomberg reporting 80% of companies have outperformed so far. Julian Emanuel of Evercore looking to earnings and the Fed decision tomorrow, saying, quote, while the phase out of the 3-cut baseline has been met with increased market volatility and a correction, it does not mean the end of the cyclical bull market. Julian, I'm pleased to say, joined us now for more. Julian, good morning to you.
Good morning.
Your note this morning got the attention of both me and Lisa. The title, Pop in the Question. There's no upcoming marriage. This is the question. All these critical events, the earnings, the data, they take a backseat to when the media pops the question to Chair Powell at Wednesday's presser. Could you see the Fed's next move as being a rate hike under any circumstances? When that question is asked, no doubt by someone like Mike McKee, how does he answer it?
So here's the dichotomy of the situation is that, we've had an overabundance of things. We've had an overabundance of growth. The strength is probably better than anyone could have expected, particularly given that you had soft spots in the rest of the world. And as you address now, sort of getting better. But also, obviously, inflation has been hotter than expected. So in the perverse logic of financial markets is it's entirely possible that the Fed chair could lead us to a path where there's a little bit more tightening of financial conditions in answering that question, which ultimately gives you the room several months hence to make that rate cut. So we think there could be some volatility on Wednesday.
Are you basically saying that this is a Fed chair that wants to induce a market sell-off?
I don't think that he would be incredibly unhappy about it, okay? Because basically, again, this is the sort of the conundrum where they've gotten themselves stuck into because of the success of the dovish pivot in a lot of ways, certainly warding off a potential downturn. But from our point of view, we've always thought, it's been Ed Hyman's core thesis, that last mile in inflation has to be accompanied by a slower economy.
So this is really a key question that a lot of people have been asking, which is basically how much the pivot last year caused inflation to be stickier and push the Fed further away from their goal. How much of a sell-off do you think the Fed needs to get back on track with 3 rate cuts or even 2 rate cuts or even 1 rate cut this year?
Well, look, I don't think there's a coincidence that when you look at the month of April, and everyone's talked about the statistics of the month of April and an election year being a positive month, and lo and behold, we've gotten what we got last year, essentially when rates approach 5%, stocks stall. So, frankly, you could also get a scenario where markets just sort of correct in both time and price, and we sort of wind our way down. But I think the fact that animal spirits have been somewhat contained in the month of April is going to end up ultimately working in the Fed's favor.
Would you like a recipe for bearishness from Chef Marko Kalanovic over at JP Morgan? This is what he got to say. Concerned about the repeat of last summer's drawdown, the growth policy trade-off could move away from Goldilocks, together with a continued risk of concentration reversal, 2 steep projections for earnings acceleration this year, and position unwind. It's a long list. What are you most concerned about on that list?
Look, the whole concept of being incredibly concerned about a drawdown like last year is a bit of a red herring.
Why is that?
Because an average drawdown in an average non-recession year is 13%. We were spoiled by last year. We only went down 10%. The VIX is 14 versus an average of 19.5. We should be used to more volatility. And when we think about everything that's going on in the world, and we think about what we're going to have to do on November 5th, it's not surprising that we get that volatility. We think we get it, and we think it's going to be okay for markets.
I just have to say, John, I have a lot of time for your recipes and for, the bearish
Chef Marko.
Yeah, bear ratatouille. I mean, I just love this.
Restaurant lovers world over will know Chef Marco Pierre White. This is not Marco Pierre White. This is a very different chef.
I mean, we have different recipes that are coming together, and I think that some people are talking about the recipe this week for risk outside of the Fed meeting. And actually, we just had a litany of people opening the show saying the Fed was less relevant, even if someone pops the incredible question, but that actually it's about earnings, and actually it's about some of the employment data that we get. Do you think that could be more of an event risk in a real significant way than the Fed, or do you think ultimately this all comes down to rates and people just aren't admitting it?
Well, look, if you look at the day-to-day, there's no question about the fact that earnings have had a day-to-day effect. Only what we're seeing this quarter is the same as what we saw last quarter, ups and downs. And frankly, the greater correlation has been what positioning looks like. The stocks with massive amounts of shorts have seen better reactions. We've seen gaps in some of the major names. And the stocks where there aren't shorts, and in places like industrials and trucking in particular, where there's a potential that their message is going to be that the economy will slow later into the year or next year, you've seen poor reactions. But again, when you think about it long term, and this is why, despite our view of a correction phase, we're optimistic, is that earnings drive stocks, and earnings, by and large, are not great, but okay enough.
Julian, you mentioned November 5th. You mentioned a lot of volatility. You're embracing it. So how do you position for it?
Well, we think there's two ways of looking at this. First of all, there's a tried and true track record of sector outperformance in that time between the last Fed hike and the first cut. First cut now obviously continues to get pushed out in time. Communication services and the more defensive sectors, healthcare and consumer staples, which in fact, if you start seeing higher rates, have that dampening effect on animal spirits, on sentiment. Those will start to perform even better. But the other thing that we want to do is we want to fully embrace what we call the AI revolution. The problem with that for a lot of people is there's been an unbelievable amount of volatility in these stocks in recent weeks, both to the upside and the downside. So what you do is you buy the stocks and you use options hedges so you can sleep at night.
Got it. That's helpful. Julian, thank you. Julian Emmanuel of Evercore, particularly when you drop 10% on any given day on Nvidia for apparently no reason. Bizarre Friday, 2 Fridays ago. Let's put it that way. Dollar yen, that's been bizarre. Let's talk about that. Right now, 156.90. Yesterday, we broke through 160 briefly and then gapped lower. The gap lower has been a bit of a mystery. The Wall Street Journal initially reporting there was some intervention based on their sources. Here at Bloomberg, Lisa, we've been waiting for the data. What does the data say?
The data says that according to some of their accounts, it shows about 5.5 trillion yen worth of intervention in their currency. I did the math. That's about $35 billion. What I'm looking at right now is a sort of test balloon, a trial balloon. Basically, how much can they do for their money as they try to get ahead of a Federal Reserve and data that they cannot control? And really, that is the question. Was this successful? The jury's still out, because ultimately it's just basically buying time before you get something more definitive on the U.S. side.
You mentioned George Saravelos to close out last week over at Deutsche Bank, and this was the quote from him. The Bank of Japan needs to engineer an expedited hiking cycle similar to the post-COVID experiences of other central banks in order to put a floor or a ceiling on top of dollar yen.
And what we've heard from the Bank of Japan is a lack of willingness so far to do so. So if that's the case, are they counting on the Fed in the meantime coming out maybe a little bit more dovish than the market is expecting, which some people think is possible, data to weaken? Or are they trying to see, okay, how much bang can we get for our buck? And that kind of is how it felt.
Yeah, when Mike McKee pops the question in tomorrow's news conference, I think that the Bank of Japan's just hoping he says no.
Will you?
No hikes.
Fed Chair Jay Powell to ever think about possibly hiking again?
No. I think that's what Governor Ueda wants to hear.
I'm offended.
Yeah, that's how that proposal's going to go. This was good. I enjoyed the note. Thank you, sir. Let's get an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. It's a surprise exit. HSBC Chief Executive Noel Quinn is stepping down. He was at the job for nearly 5 years. The board has now started the formal process to find a successor. In a statement, Quinn said, doing this job, you have to give 100%, if not 120%. That doesn't necessarily achieve the balance in life that I wanted. He is leaving the company at a high. HSBC reported a beat on its pre-tax profits and a $3 billion buyback. Now, it's also been a very busy week for Paramount Global. The company announced that CEO Bob Bakish is stepping down. He's going to be replaced by 3 senior executives. Also, Paramount reporting first quarter earnings that beat estimates, helped by CBS's broadcast of the Super Bowl in February and, dare I say, Taylor Swift's appearance. David Ellison, Skydance Media, is now negotiating a deal for the company, which seems all the more likely with Bob Bakish out. Boeing has raised $10 billion yesterday in a bond sale. It will help ease some of its financial strains. It attracted $77 billion of orders. Now, that outsized demand was helped by Boeing dangling a strong yield premium, but it's also a sign that the U.S. credit market is wide open despite a shift to price out rate cuts, that perhaps the warm reception is more about insatiable demand for issuance more than the prospects for Boeing's credit. That's your Bloomberg Brief. John.
Danny, thank you. We'll catch up with Danny in about 30 minutes' time. That proposal felt like one of those awkward fan cams at a basketball. You know, have you seen those videos? He gets down on one knee and the girl just sort of runs off.
Okay, whoa. How many of you
You've not seen those videos? Oh, yeah, the girl runs off.
Is
she gets very upset.
Is that what populates the automatic algorithm in your Twitter feed?
Yeah, that's what comes up on YouTube Shorts.
I get animal videos.
You get animal videos. I get women running away from men trying to propose.
Not a good figure.
Get it? No? Okay. Up next, the ceasefire on the table.
In this moment, the only thing standing between the people of Gaza and a ceasefire is Hamas. They have to decide, and they have to decide quickly.
That conversation just around the corner, live from New York City this morning. Good morning.
Wednesday, the Fed decides.
Jay Powell pumping the brakes on rate cuts.
Hikes are off the table. No cuts looking perhaps a little bit more likely.
You can't say there's a whole lot wrong with the U.S. economy.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Our policy rate is likely at its peak.
The threshold to cut rates is a little higher.
We're redefining patience.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Live from New York City this morning. Good morning. Equity futures on the S&P 500 down on the session by about 0.1%, down on the month by something like 2.6% so far on the S&P. The fact that that's the biggest monthly loss since September tells you how good things have been for the equity market over the previous 5 months. Yields are higher by 2 basis points, up to about 463.23 on a US 10-year, and crude well behaved to end the month in the low 80s, 82.82, positive on the day by 0.2%. Under surveillance this morning, a ceasefire on the table.
Now, the quickest way to bring this to an end is to get to a ceasefire and the release of hostages. Hamas has before it a proposal that is extraordinarily generous on the part of Israel. And in this moment, the only thing standing between the people of Gaza and a ceasefire is Hamas. They have to decide. And they have to decide quickly.
Here's the latest this morning. Mediators urging Hamas leaders to respond to a proposed temporary ceasefire. The deal would see the release of Israeli hostages and delay an invasion of Rafah. Secretary of State Antony Blinken continuing his trip in the Middle East with stops in Jordan and Israel. Former senior US intelligence official Norman Rule joins us now for more. Norman, what if I get you to get your perspective as always? I think we've heard this story a few times and it's been a series of false dawns. Do you get the impression that this time is different?
Good morning. It is different. We are approaching an inflection point. Israel has completed its final preparations for an operation. The administration continues to state that its concerns regarding the humanitarian impact of that operation have not been entirely assuaged. But Israel is reaching a point where it's got to decide whether to go against Rafah or not. The deal that is made involves a number of significant concessions. Israel has lowered the number of hostages it is seeking. It has increased likely the number of Palestinians it will release, and it will have a ceasefire that in essence provides Hamas with a victory of survival. So the next few days will be quite important.
Why would Hamas say no then to this deal on the table?
For Hamas, a deal is important because it allows survival. But at the same time, Hamas has got to decide within itself, has it reached the end of its ability to put pressure on the United States and Israel? If it decides it's reached the end of that point, if it decides that it faces a life and death moment with an Israeli attack, then it's going to be more likely to accept a deal. But if Hamas believes further concessions are likely, it will not approve this offer.
Norm, is a ceasefire, or does it just mean that it's on pause in terms of this Rafah invasion? Does this just push it back, or actually will Israel, if they strike this deal, not go in?
I think there are three different perspectives. The entire Israeli cabinet believes that it's important to eradicate Hamas's leadership and its capacity to be a military force. So even for those who support the ceasefire in Israel's cabinet, they're looking at something that is temporary. The United States is looking at a temporary deal that it can then extend into a longer ceasefire, permanent ceasefire for a political settlement. And of course, Hamas is looking for the withdrawal of all Israeli forces from Gaza and its return to power and in a permanent ceasefire environment. That's the dance that's taking place at present.
Norm, you're at the World Economic Forum special meeting in Riyadh right now, and that's a key place to answer a question that I had when I was reading some of the reports about the latest discussions, which is who's going to fill the void when Israel pulls out in this ceasefire? Is it going to be Qatar, Saudi Arabia, United Arab Emirates?
None of these partners, according to my discussions, are willing to take the lead in such an effort. It's just not a good thing to have Palestinians shooting at Arab forces or international forces. They're all looking for some sort of U.S.-led process by which they can participate in some way to allow the Palestinian Authority to reassert itself in Gaza and the West Bank. It's not entirely clear that the Palestinian Authority is prepared for that. Palestinian President Mahmoud Abbas spoke at the World Economic Forum. His comments were, let's just say there was not a lot of new there, and there wasn't a lot of indication that he has that capacity. But the conversations among diplomats here in Riyadh have been intensive and extensive on this issue.
But Norm, are you basically saying that if this ceasefire or temporary pause, whatever you want to call it, gets effectuated, that essentially U.S. troops could be on the ground keeping the peace in Gaza?
Very unlikely. U.S. forces are very unlikely to be involved in any on-the-ground effort. The Biden administration has been consistent in that regard. The problem is there is no other entity that's willing to step in. There have been discussions of maybe an international force, but those discussions really haven't gone anywhere. This is a work in progress and a critical issue to be decided.
Norm, anytime you have the Secretary of State, Antony Blinken, in Saudi Arabia, everyone starts whispering again about this idea of normalization. Are we any closer to that today between Riyadh and Jerusalem?
No, but we're no farther away either. The Saudis have made their position quite clear. They're looking for a finite, clear, and concrete path to Palestinian statehood, and that must be worked out by the various diplomats involved. And until that happens, and until they see that's going to occur in a manageable manner, they're unlikely to agree to restoration, or rather normalization of relations with Israel.
Norman, thanks for making time for us this morning. We know you've got a busy evening ahead of you. Norman Rule there, the former senior intelligence official. Let's just take the temperature of things in the commodity market. Crude on the month is high by 1.2%. which is pretty marginal stuff relative to what's actually taken place so far this month. People like Norman Rule saying this is a new Middle East. New lines have been drawn around the confrontation between Israel and Iran, and yet here we are with crude higher by 1.2%.
Especially given the fact that there was actually the specter of direct confrontation between Iran and Israel. And that was taken off the table, and maybe the de-escalation is what gave people confidence that maybe we weren't going to see true oil disruptions. What I think is interesting is that we're higher, 1.1%, on the fact that inventories have been taken down. There actually is fundamental reasons for there to be some feeling that maybe we could see higher prices unrelated to what's going on in the Middle East.
Few things. People are starting to erode some of that geopolitical risk they put into the price. And two, global supplies still have not been hit. There has been a tremendous amount of missiles flown back and forth, but actual supplies have not been hit. Until that happens, probably not going to see this market take off.
Yeah, you can sense the reluctance of this administration to do absolutely anything that disrupts global oil supply. That's the story with crude. Story with equities right now. If you're just waking up and tuning in, welcome to the programme. Equity futures on the S&P down by just 0.1%. Plenty to talk about in the FX market. Coming up shortly, we'll catch up with Winthin of Brown Brothers Harriman as the BOJ accounts point to so-called yentervention. What do you make of that, yentervention?
I don't like it.
No?
Actually, you know, it's kind of cute. It sounds like yenta. But it sounds like yentervention. You're going to go there?
You know, I've used it a couple of times in the last day. Kind of works.
You think that you could use it for other things too?
What like?
You're going to bring that into the conversation? Doing another yentervention?
Yentervention?
No?
I guess it doesn't work, does it? Through 160 yesterday, briefly, gapping back down, trying to figure out what was behind it. Most signs point towards yen intervention.
Very good.
We'll talk about that in just a moment.
I killed it for you?
Thank you. Yeah, I think it's died. From New York City, this is Bloomberg. The month of May just around the corner, closing out the month of April with equity futures negative by 0.2% on the S&P, similar move lower on the Nasdaq 100, down on the month, down on the session. Over the next couple of days, Amazon later on this afternoon, Apple Thursday, you'll get about 10% of the index reporting earnings across just two names. That's the equity market. In the bond market, we look a little something like this as the first day of the Fed's two-day policy meeting concludes tomorrow afternoon, 2 p.m. Eastern Time. Yields are higher by almost a basis point. On a two-year, 498.30. On 10s, Bramo, 463.43.
It's a long-term trajectory that I find actually most interesting about the narrative shift in April. Essentially, people are talking about the idea that maybe rates are not restrictive and that maybe they could stay around here for a much longer period of time. If you get a Federal Reserve that indicates that in any way, if they get popped the question and they indicate the wrong answer, how big of a sell-off could we get if people truly have come around to this idea that earnings are resilient enough to keep this going even with rates where they are?
Given that Chairman Powell knows what question is coming in the news conference, do you think he fumbles it or not?
You know, you've asked this before, and in the past we've said no way, and he still fumbles it, right? So ultimately, I'm not going to weigh in on that.
Would you consider hiking interest rates? Yes, no, yes.
Yeah, intervention.
Yes. And then go through the paper.
Practice.
Let's talk about the euro. Okay, the euro right now, 107.32, positive by 0.1%. Under surveillance this morning, the Eurozone exiting a recession with better than expected GDP data to start the year. Consumer prices also rising 2.4% year over year to meet estimates. The gains helped by an improvement in Germany as it faces a troubled industrial sector. Those troubles still persist, but ultimately, relative to expectations, surprises in Germany, France, Italy and Spain, and the right kind of surprises this time around.
You put it well when you said basically, is this the U.S. becoming less exceptional? Is this basically a broadening out of what we experienced in the United States and the rest of the world, where growth is coming in better than expected, but inflation is remaining stickier than expected? And then how does the ECB respond to this? The euro doesn't know what to make of it, neither do we. But I think that the key is, just a question of, is this not just a U.S. story?
Euro's been dazed and confused for months now.
Yes,
but I'm with you. It's about how you close the gap. So you've got the U.S. up here, Europe and the rest of the world down here. Is it the U.S. coming down to the rest of the world, or is it the rest of the world coming up to the U.S.? And based on the data we had overnight, China, Europe, things getting, relative to expectations, a little bit better.
Absolutely. Things are getting better when you look at China and when you look at Europe. What's interesting, though, about China is you do see a lot of emphasis on exports, which makes you think that, okay, what's happening on the domestic front? Where is that domestic demand? Interesting, an IMF official actually came out and said it's actually not overcapacity. Touring Asia right now and said it's not actually overcapacity, but they do need to do more when it comes to their domestic demand.
Yeah, I think the Americans have got a very different perspective on that issue. Speaking of Europe, car makers, nothing good about it at all. More headwinds for EVs and a broader sector. Volkswagen, Stellantis, Mercedes, all reporting disappointing sales to start the year. Meanwhile, the information reporting Elon Musk is planning hundreds more job cuts, with 2 more senior executives set to leave Tesla. That stock is down by 2%. But listen to this, Lisa. Mercedes first quarter earnings down about a third. Volkswagen earnings down about 20%. Not pretty.
Electric vehicle demand down, and that's what we're really seeing across the board, but even in Europe. Let's link the stories. This idea we were talking about China and overcapacity and the IMF saying no. This is going to be the first time the Chinese president Xi Jinping is going to be coming to Europe. Where is he going? He's going to come May 5th. It's the first time in about 5 years. He's going to France, Serbia, and Hungary. What's he probably going to be talking about? Buy our cars. This has been an area that has been less immune to some of the exports from China at cheaper price points. This, to me, is going to be interesting. Do they get some sort of division between the U.S. and Europe, or is this going to be something that's really focused on EU?
60, 30, 10. China, Europe, U.S. That is where sales are when it comes to EVs. So China and Europe really need to start buying more in order for these car companies to do better. And you can see that across the board in the auto sector.
Attempted to open some more BYD factories and get the brand. Yeah, you know what? Are people actually going to buy the brand, though, in places like America? You're going to buy the brand, China, BYD? Is that really going to take off? Even if you didn't have the walls, you lowered them. Even if they are really cheap. Is that going to take off?
It's not going to happen in the U.S., but it might happen in France, in Serbia, in Hungary. And I think that's the reason why it's telling that Xi Jinping's over there.
In Italy, the presidency of the G7 is looking at potentially opening up a BYD plant, yet they ditched Belt and Road. What's the difference? I don't quite understand. But to Sarah Hunt's point yesterday when talking about the iPhones, that luxury appeal of a brand, similar point you have to make by BYD. BYD is not the same, I think, in a lot of Western minds as a Tesla.
As Lisa said, May 5th, the Chinese leader heading to Europe. Let's finish on this. Secretary of State Antony Blinken continuing his trip in the Middle East, making stops in Jordan and Israel. Blinken urging leaders of Hamas to accept a deal which would release Israeli hostages and delay an invasion of Rafah. This marks Blinken's 7th trip to the region since the Israel-Hamas conflict began last October. Annmarie, there's a sense this morning that this time might be different. We might be closer to a deal.
And that's because Secretary Blinken came out and said this is the most generous deal that Israel's putting on the table. What I was talking to individuals last night, a lot of individuals from the region, is that you have representatives from the United States, Hamas, Qatar, and Israel all going to be in Cairo today. And then yesterday, the president got on the phone with El-Sisi of Egypt and Sheikh Al Thani of Qatar. A lot of pressure from the United States on all of these countries or teams to accept this deal.
We'll return back to this story throughout this morning. Let's turn back to foreign exchange and the yen falling against the dollar following new accounts from the BOJ indicating it likely intervened on the currency yesterday. Joining us now to discuss is Win Thin of Brown Brothers Harriman. Win, is it sufficient even if they did intervene in this FX market?
Hi there. First of all, again, thanks for having me. I always enjoy coming on your show. My short answer would be no. I continue to go back to monetary policy divergences, and that's what's really been driving dollar yen higher, especially with this latest round of Fed hawkishness, coupled with really a quite dovish hold from the Bank of Japan last week. That invited further dollar yen buying. The market didn't disappoint. I guess I'm a little disappointed that the Bank of Japan didn't think this out or doesn't appear to have thought this out quite clearly, because they even made a specific mention of how the weak yen wasn't impacting inflation yet. Again, another invitation to take dollar yen higher. So until something happens, either on the Fed side, it gets more dovish and starts cutting rates, or on the Japan side, the Bank of Japan side, where they start getting more hawkish and hike rates, I can only see dollar yen going higher.
When people like to throw around the word crisis, particularly in financial media, crisis, currency crisis, what would a crisis look like? And do you think we have the ingredients for one?
Again, I'll give you a short answer, no. I think, it's always, markets are always looking for the next sort of shoe to drop or some sort of trauma for the markets. But, the strong dollar is a problem for many countries, but it's not a crisis. I think if we started to get sort of dislocations in other markets, say the JGB markets or the U.S. Treasury markets, something wider than just this exchange rate, we could maybe start talking about a crisis. But I just don't see the seeds there. This is really it's a strong dollar issue. It's not just Japan. We know that Korea is complaining, others also, especially in emerging markets. But I don't see anything like a plaza type accord emerging anytime soon. The movements just haven't been that large and that disruptive yet. But again, it's worth keeping an eye on.
When the idea of $40 billion, $50 billion, $35 billion of yen intervention, not significant in the scheme of things. The idea of hiking rates, much more significant. Do you think that puts this back on the table for the Bank of Japan in a more material way?
Well, yes. I think, again, they delivered such a dovish hold last week that I was really quite shocked, because they knew that the currency markets and the markets were looking for something more hawkish. The first next step would be a more hawkish forward guidance, because right now the market's only pricing in something like 50 or 60 basis points of tightening over the next 2 years, which is obviously a very shallow tightening cycle. And again, the Bank of Japan's guidance hasn't helped. But overnight, we had some soft data from March, IP, retail sales, housing starts, that sort of underscores why perhaps the Bank of Japan is being cautious. But again, you can't have your cake and eat it too. If you're going to be dovish, you're going to have a weak currency. If you want to really, really put a floor under your currency, I think you're going to have to hike rates. And at this point, I think the Bank of Japan is so gun shy. I mean, think about it. The last 2 times they've tried to hike rates, Japan has fallen back into recession. So I understand why they're being so cautious. But again, there's so many moving parts. I just don't know how well thought out this policy path has been.
There's a broader point here, and it's a real question that we've been asking all morning. This idea of, as John said, is this basically the U.S. exceptionalism running out of being exceptional and the rest of the world kind of coming to that same place where growth is stronger and inflation is stickier, and that means higher rates globally, where a lot of central banks cannot lower rates nearly as much as many people previously expected. Is that basically what you're looking at in this mishmash of foreign currency moves that basically have left all of us scratching our heads?
Yeah, that's always the problem with foreign exchange. It's not an absolute story. It's always a relative story. And the U.S. exception is absolute in the sense that the growth is multiples of what we're seeing in Europe or elsewhere. But the relative story has shifted recently. I have to say the one thing I did get wrong in this last cycle is that I think the UK and Europe has been more resilient. I thought they would be in a much deeper recessions. And we're already seeing, obviously, the European data out earlier today. That was quite shallow. But when I still step back, it's still hard for me to get excited about Europe. I still think there's a lot of headwinds. Europe is much more dependent on China. I remain very negative on China, despite some signs of life there in the economy. So maybe we're not quite as exceptional as we were before here in the U.S., but we remain, I believe, relatively exceptional. I still like the dollar higher. The Fed is going to, I think, deliver a very, very hawkish message tomorrow. You were joking earlier about whether Mr. Powell can sort of stick on script. I'm pretty sure he's going to have it written on his hand, don't say anything about cuts. And if he sticks to script, I think that we'll be okay. But I really, I think markets are always looking for some kind of dovish slip from Mr. Powell. I continue to think if they want to do an insurance cut or two this year, but the data just won't allow them. And so it's sort of a waiting game to see how the economy evolves.
Let's pick up on that final point. You said he's going to be very, very hawkish tomorrow. What do you think that actually sounds like? What do you think he's going to say?
He is going to, I don't think he's going to say the H word. I believe the hype word is not really in his vocabulary at this point, but he will continue to say that the rate cuts are going to continue to get pushed out. Remember, earlier this year, he was saying, well, we're going to cut rates sometime this year.
Yeah.
And it sort of said there's coming soon. But he can't say that. He's going to really just say, look, it's all going to depend on the data. The data are not allowing for a cut right now. We don't have confidence that inflation is going to the 2% target relatively soon. Again, these are all things that the Fed officials have really talked about before the blackout period. And so I see a continuation of that. Nothing has happened since the blackout period began that makes me think they have to change the script. The data remains strong. We're looking at 250,000 plus jobs this Friday. Inflation remains sticky and actually higher. So to me, it'd be very, very difficult for the Fed to deliver anything short of a hawkish message tomorrow.
We've got a show to promote tomorrow, Win, and you're not helping. You're basically describing a guy who's going to sit there with one hand, don't cut, don't say it, and on the other hand, don't say hike either. So this is going to be fun. Win Thin of Brown Brothers Harriman. Win, thank you. Looking ahead to the Fed tomorrow afternoon.
This feels like preschool or kindergarten.
You think?
There's the H word, there's the T word, there's the C word. Don't say hike, don't say transitory, don't say cuts. Just sit there like a deer in headlights and say, hi, we're the Fed.
TK would always say it, just reach for the notes. It's going to be one of those news conferences, isn't it? Just reach for the notes.
Or your palm is from Win Thin.
Yeah, apparently your palm as well.
Just don't wash your hands. Honestly, look, I personally think he has to come out, and this is Julian Emanuel's point. Doesn't he want a sell-off? Doesn't he want to prolong the sell-off in order to get inflation to a place where they can do some of the cuts that they're looking for? And if he is willing to do that, well, then why not come out and say the H word?
If you'd said that back in August 2022, I would have said, yeah, that's exactly what he wants now. Ask him where financial conditions are. Ask him if he thinks they're loose or tight. And he'll tell you already he thinks they're tight. He thinks they are sufficiently restrictive.
John Williams went there. And John Williams is dovish. John Williams said the H word. He said he would consider it. So I wonder if that sort of paves the way for that to be washed off his left palm.
Let's see how they navigate that tomorrow in a presser. Some headlines coming from the Prime Minister's office in Israel. Benjamin Netanyahu saying this: we won't stop the war before achieving all its goals. Bear in mind, these comments are coming against the backdrop of ongoing talks between Israel and Hamas, and a lot of experts around this story suggesting we might be very close to some kind of ceasefire. And going on to say this as well, Annmarie, we will enter Rafah. We will eliminate Hamas battalions.
So this says to me that even if they get an agreement on the table, Netanyahu is determined to go into Rafah and make sure that every last bastion that Hamas holds is eradicated, which these kind of comments, as they're sitting down in Cairo, potentially their representatives discuss this deal, could potentially mean the deal would be off. To Norm's point, a ceasefire is a ceasefire, but until what point? Does this just mean 6 months and then potentially Israel recalibrates and goes in? We're not sure yet. We have to wait and see.
The objectives have not changed, according to the Prime Minister's office. Let's get you some stories elsewhere. Let's get to your Bloomberg brief now. We can catch up with Danny Berger. Hey, Danny.
Hey, John. Elon Musk's wealth is once again climbing the rich list. Tied to the performance of Tesla shares, Musk gained more than $37 billion in net worth in the past 5 days. That according to the Bloomberg Billionaires Index. Now, off the back of news that he had gained support for his driver assistance program in China, Musk added $18.5 billion to his fortune yesterday. He now has a net worth of more than $201 billion, and he's close to overtaking second place Jeff Bezos. And we're still talking about return to office. This time it's Macy's. They've issued a mandate to corporate employees get back to the office or face disciplinary action. The company informed its hybrid employees that they will need to be in the office 2 days a week. That will start May 13th. That, according to people familiar with the matter. Macy's is giving employees a 3-month grace period to move back to the New York City area. And if they haven't returned by then, workers will risk consequences, including termination. Cocoa prices plunging by the most ever. They've fallen by nearly a third in 2 days. Don't forget, they surged more than 100% this year alone. But the price swings are becoming more extreme, and fewer investors and companies can maintain trading positions. A supply deficit had made cocoa more expensive than copper this year, but now liquidity has drained from the market. That's your Bloomberg Brief. John.
Summer diets everywhere, Bramo.
Exactly.
You said it as Danny was speaking. Danny, thank you. As Danny was speaking.
This is Operation Tread.
Absolutely.
Like surveillance.
Crater rate.
Going into Memorial Day weekend, of course. Up next, slim odds. There you go. For the Fed's first cut.
As the labor market gets into better balance, that should slow the rate of wage growth, and then that brings back down the super core rate of inflation. So that's kind of what we're looking for in terms of, the Fed easing later this year.
These jokes are getting so much worse. That conversation's just around the corner, live from New York. This is Bloomberg. Equity futures on the S&P 500 pulling back by just 0.1%. No drama here in the equity market this Tuesday morning. Yields are higher by a single basis point on the 10-year 463, and the euro advancing. GDP a little bit better across the top 4 Eurozone GDP economies. The countries, France, Germany, Italy, Spain, all doing better than expected. 107.28 on a euro right now. Under surveillance this morning, slim odds for the Fed's first cut.
The labor market is also getting into better balance in terms of supply and demand. As the labor market gets into better balance, that should slow the rate of wage growth, and then that brings back down the super core rate of inflation. So that's kind of what we're looking for in terms of, the Fed easing later this year.
Here's the latest this morning. The Fed's 2-day meeting kicking off with the central bank widely expected to hold rates steady. A string of hot inflation prints and labour market strength setting the stage for Fed Chair Jay Powell to make a hawkish pivot. Claudia Sam of Bloomberg Opinion writes in this: this strong economy does not complicate the Fed's fight against inflation, nor is it a reason for the bank to delay rate cuts. Notwithstanding 2024's bumpy start on inflation, there is reason to believe that the trade-off between demand and inflation is weaker now than in the past. The brilliant Claudia Sam joins us now for more. Claudia, let's go to that final point first. I'd love to get some thoughts on that. What are the forces that is changing that relationship between demand and inflation?
Well, first and foremost, the pandemic came through the economy and disrupted us in ways that we have not seen in living memory, right? Like, this was fundamentally a different kind of, really twist and turn the ability of the economy to produce. One that was really important that we unwound last year is we had a notable labor shortage. People left the labor force at the beginning of the pandemic. Last year, we brought a lot of workers back. That's a big reason why the U.S. economy could grow and not be inflationary, like push inflation up more, because we could meet that demand, right? That is not, when you have supply disruptions, you have the opportunity to fix them. We did that with the labor market largely last year. And then you can get these two pieces together. Right. And it is unusual. Usually it's that we got demand out of control and it's hard to get supply. This time we fix things on the supply side.
It's been impressive to see how that's played out over the last 12 months. Could we focus more on the last 3 or 4? Claudia, the Fed seems to be preoccupied with the recent upside surprises of the start of 2024. They've described them initially as bumps in the road, and now they're starting to sound a little bit more concerned. Why shouldn't they be concerned by these positive surprises, so-called upside surprises of the year so far?
They should be concerned about everything. I mean, we all are staring at every month of inflation data that comes out. We did learn, especially last week, that January was the month that was just a mess, right, in terms of inflation really picking up. We didn't see the path back to a real disinflation in March. I think that was the disappointment. That's one that Powell really seemed to think we were going to get back on track in March. We didn't. And so, I get it, but there's a lot of pieces left in inflation, like the owner's equivalent rent that we talk about, the vehicle services, the vehicle insurance. It's like, what level of interest rates do you need to get those things down in a sustainable way? Right? They're very complicated. They also have the supply aspect. And with the shelter costs, they're very backward looking.
What's the upside, Claudia, though, of Fed Chair Powell saying the C word? I mean, we've heard basically we're playing kindergarten Federal Reserve version. We're talking about the H word hike. Is he going to entertain that? Is he going to talk about the T word, transitory? No, that's absolutely a dirty word. C word, if he talks about cuts, I mean, what's the benefit to him?
There is none. I mean, really, if he opens his mouth, there's all downside risk, right? Like and this is, I think, to a place where we all want certainty. We all want, and we look to the Fed as some oracle, which we should not. And thus, what comes out of his mouth, what comes out of Powell's mouth, people want to grab onto. They want to hear, but they want to hear. And off and running they go. Powell will aspire to be the most boring he possibly can tomorrow. I can't imagine the Fed wants to move the markets out. I mean, less than 2 cuts. 2, 1, 0, like the September meeting where that could get started with 2, they have 5 more CPI prints. That is forever. We could be back in the why haven't they cut yet discussion. I mean, like things can move very fast. And I don't, what possible reason does he have to like reset expectations? Like just, take a breath. This was disappointing. We don't know what comes next. And he will totally emphasize the data driven. If the data gets better, things get better. They get worse.
Well, stay tuned tomorrow, because tomorrow afternoon we'll be covering Jay Powell as he attempts to be the most boring guy in the history of the Federal Reserve. Claudia, I'm curious, though, as you talk about this idea of the Fed kind of being in a bad spot either way, they do have some communication that acts as forward policy, as monetary policy. And there is a theory, and Julian Emanuel was talking about this, that if there was a sell-off, more protracted sell-off in equity markets and risk markets, that could help the Fed get to their goal of lower inflation. Why do you disagree with that?
The Fed has really struggled, and this makes sense. They have really struggled to fine-tune forward guidance, right? It's like it's very hard to predict what the markets are going to do, what they're going to go off and running about. As was said before, Powell has looked at this economy and said interest rates are restrictive. We are putting downward pressure on the economy, and you can see it in some interest rate sectors. So do they know exactly, do we want to be 25 basis points higher or 50? I think it's just you're wading into territory that it can just get away from you. And so I think he'll just repeat, we're in a restrictive territory and they're ready to do whatever it takes to get inflation down.
Claudia, when you talk about we're seeing the biting of some of the higher rates, we're not seeing it from some of the biggest companies. They're still reporting earnings that are delivering enough of a positive surprise that people are enthusiastic about the prospects for corporate America. Do you think that this Fed should err on the side of protecting smaller businesses, of protecting a whole host of consumers that are more affected disproportionately by higher rates at the expense of a higher long-term inflation rate in the United States?
The Fed's mandate is for the country as a whole, right? So they are not set up in a way to pinpoint certain groups of consumers, certain groups of businesses and say, we're going to give you relief on interest rates. They're focused on getting inflation down. I think the one thing that speaks to we don't need to turn the cranks that much is, we are within less than a percentage point of their goal. Right, like we're not at the 5% of core inflation, core PC inflation that we were, back before the disinflation started. So we don't need to get too worked up here about 3 months of data, and yet take it very seriously, right? If it gets stalled out here, this is a problem, and the Fed will adjust course. It's just like swinging around this much expectations in markets. It feels overdone.
Claudia, appreciate your insight into the story. Claudia Sahm there of Sahm Consulting on the Federal Reserve and Chairman Powell tomorrow afternoon. If he opens his mouth, there's downside risk. That's going in the promo too.
100%.
It's quite a start to this morning, isn't it? Day one of the 2-day meeting of the Federal Reserve. Tune in at 2 p.m. Eastern tomorrow for
the most boring guy on earth.
Okay, wonderful. The politics. I wanted to talk about the political calendar. Another note, this time from BNP Paribas, the economics team over there saying this: delaying the start of the cutting cycle to July, if you can call it that, while remaining of the view that the presidential election likely precludes a cut in September. Consequently, we now see the Fed implementing its first cut in December. So they pushed out to July. They're pushing it out to December now. Lisa, it keeps coming up again and again, the importance of September and the lack of willingness to do anything at that meeting.
given the fact that historically it's always been a bad move. I mean, if you think about it, right before an election, you've been talking about this, Annmarie. So it's basically July or December. Conversation continues in the next hour on Bloomberg Surveillance. Dan Greenhouse of Solus, Bloomberg's Craig Trudell, Geetha Raghunathan of Bloomberg Intelligence, and BlackRock's Amanda Lynham. Equity futures recovering just a little bit softer. This is Bloomberg.
There's very little room for the Fed to be particularly dovish or quick in terms of rate cuts.
As long as we've got a reasonably strong economy, I think the market can handle the Fed just sort of staying steady.
The market has already started to game out the Fed decision. They've already started taking rates off the table.
July is probably looking a little bit soon. It's a tough hurdle, but they'll still probably be able to cut this year.
Could they cut rates in September? If things are slowing down enough, then yes.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning, good morning. For our audience worldwide, equities recovering just a little bit. Equity futures still negative by 0.04% and down hard on the month so far, but a little bit of perspective. Yes, this is the biggest monthly loss potentially since the end of September. Yes, we're down by something like 2.6%, but really, this is really about the 5 months of gains previous to this, prior to this, Bramo, which were just out of this world.
And frankly, the fact that we're down so little is to me really telling, given the fact that we saw some pretty big misses on a number of the tech stocks. To me, the swinging around of the tech names is really interesting. We haven't talked enough about the fact that Amazon's coming out after the bell. What if they miss on AWS?
You missed yesterday. 24 hours of it.
Okay.
Just Amazon on repeat.
You know, I actually watched the show, and I know that that's not true. So I'm going to call you.
Did loads of
that.
Apple as well on Thursday.
I know.
We did.
I know you mentioned it.
We did a whole segment with an analyst.
I saw that. I did watch it, and I will just say that I think that everyone yesterday was talking
Why
about
are you tuning in on your day off?
That's what my question was. Because I love you, and this is where I get my information. So there you go. I think that this is really important. You know, it goes back to whether Fed Chair Powell is going to pop the question today, but yesterday it was all about
love and proposals.
Yeah, but it was all about yesterday why it wasn't going to matter what happens there, and it's all about earnings. So today it's almost flipping the script completely.
We've missed you, Bramo. Let's talk about bearishness in the bond market. Let's get to the month so far. The 2-year and the 10-year, we're talking about moves of 30 plus basis points and moves of 40 plus basis points on both a 2-year and a 10-year. If I told you at the start of the month that's the move we'd get more hot inflation prints and we'd reprice the yield curve higher this way, would you have guessed that equities would only be down 2.6%?
This has been the story. To me, this has been the issue, is the narrative shift around how much of higher rates can this equity market tolerate. And it turns out quite a bit. We heard that from Max Kettner this morning, kind of putting a bow on it. They're getting more sort of bullish on certain risk assets because, hey, guess what? Rates are high for the right reason. How long does that last, depending on whether or not Fed Chair Powell, who tries to be the most boring person on earth tomorrow, uses the H word?
I just pulled up Max Kettner's note, immaculate high for longer. This idea of immaculate disinflation, perennial Goldilocks, has given way to renewed inflation fears. And that's what makes Powell's job so much harder. But already he said enough where the likes of Jay Pawlowski said, this Fed story this week, already in the rearview mirror.
Backseat to the data and the earnings a little bit later this week. Amazon, really important after the bell.
Thank you.
A little bit later.
That's
I
true.
did that a few times. Come on.
Yesterday.
Really important. How many times do I need to do it this morning?
I just want to know, are you paying $2.99 for the subscription?
You want more? More. Really important after the close a little bit later. Coming up in a moment, you heard him. Dan Greenhouse of Solus joining us shortly with stocks poised to snap 5 months of gains. Geetha Raghunathan of Bloomberg Intelligence on the upheaval at Paramount, and BlackRock's Amanda Lynham on what the Fed's path forward means for credit. We begin with our top story. Stocks on pause awaiting earnings, economic data and a Fed policy decision. Amazon kicking off things today, followed by the Fed decision tomorrow. Then it's on to Apple on Thursday and a jobs report on Friday. Dan Greenhouse of Solus Alternative Asset Management joined us around the table. Dan, tell us how important Amazon is after the bell.
It's pretty important. I think we need to talk more about it.
Apparently.
It is. I mean, it is important. It's obviously one of the largest stocks, and it has a few different touch points. Obviously, AWS being the crucial driver for the stock and its performance in the index, but also its touch point with the consumer, et cetera. So, of course, it's important. But I think any number of other companies, McDonald's just reported, also important. And I think that the focus on those names does something of a disservice to the information that can be provided by a host of other companies, of course.
Do you think the focus should be on the earnings and not on the data or the Fed this week?
Well, no, right now the focus is on the Fed. And I think getting back to the point about the strong rally that we've had off the low, why are we pausing here? Now, obviously it comes in the context, as you mentioned, of the big rally off the low, but we're pausing here because of the Fed, because of inflation and those concerns. Earnings season has been going well enough, not awesome, but pretty good. And so obviously right now that's the focus. And so I think, the Fed meeting on Wednesday becomes crucially important. I think he's going to be boring because after all, he is the Fed chairman and there's no other mode but boring.
Speak for yourself. I find that really interesting.
Well,
frankly.
we find it riveting because we're nerds.
Okay, we'll put that aside.
A normal person would watch Jay Powell and think this is the most boring thing I've ever seen ever.
I don't have any issues. But look, I'm just wondering, you actually said in your note that basically the ultimate level of rates isn't going to matter, that it's the adjustment period. And that, oh yeah, guess what? You're going with the narrative that 5% in terms of where yields are right now, benchmark rates, isn't that problematic for stocks? So how do you sort of pair those two things with the importance and the interest that I personally have in Fed Chair Powell tomorrow?
Well, okay. First of all, I share your interest. Right. I assume the rest of the table does as well. You don't have a monopoly on being a nerd. But that said, I think don't take my word for it on interest rates. As this conversation has gone on for the last couple of months, I sit here and I seem to be the only one on financial TV making the point, interest rates have gone straight up all year long. From 420 to 5, there's been an 80 basis point move. Basically, pick the 2, pick the 10, your choice. It's basically been an 80 basis point move. We've repriced. Everyone keeps talking, well, we were expecting 6 cuts. Now it's only 2, maybe 1. And the stock market's basically at a high. You mentioned we're down a little bit, but no big deal. It's obviously not been a problem thus far. I don't know why another 20 basis points or 10 basis points is the straw across the proverbial camel's back. I think the economy has done incredibly well relative to what we certainly thought. And I think the stock market similarly has done well. Not I think, it clearly has. And so I don't understand why, getting back to your point about the short term, I think there's an adjustment period here where we're in a bit of an uncertainty, obviously. Inflation was stickier for a month more than we thought. And obviously we can parse that data out and say, well, if you X out this or you X out that, it's not that bad. Fine. But the inflation data has been a little more persistent than we thought, at least according to the CPI, not as much the PCE. And so I think we need to hear what he has to say, how he characterizes the environment before the market can resume what I think will ultimately be another push higher.
Do you believe that the market's rally in the beginning of this year, off the Fed pivot late last year, actually is responsible for some of the stickiness in the inflation data we've been seeing?
Yeah, I find it difficult to disaggregate. I think yes. How much of a contributor is very difficult to prove out in the data. I think in retrospect, the enthusiasm for rate cuts before the data and the environment clearly called for it was probably incorrect. And when I say probably, I mean even at the time, there was a lot of confusion about what's the rush, so to speak. And I think the rush was, well, we want to start cutting rates before the election, sufficiently far away from the election, assuming the data cooperates. But characterizing it in the way that they had, probably not the best. And I think in retrospect, certainly, but even at the time, you could have waited another month or two before you started getting enthusiastic about cutting rates in June. And my final point on this is, having done this, as we all have for a few decades now, good Lord, the fear of markets. Oh, we don't want to be seen for playing market. We can't pivot into. I find it silly. You could have gone another month or two before you started signaling, hey, we're interested in reducing rates as soon as the summer. The rush to do it when they did, again, was probably premature.
But they rushed to do it because they thought the data was good then. So the bumps, does that basically mean potentially that's a trend, 3 months of bumps?
Well, yeah, the data was good, but the ultimate reason was they thought the data would continue moving in the old skate to where the puck is going thing. What an awful word to have used. But
Gretzky, I'm with you. We're following.
You know. They thought the data would go in a certain direction. Obviously, it has not. January and February was supposed to be an aberration. At least in the CPI, it was not. March was a little hotter. But the PCE has been better. And I think, again, if you parse out that data, it's not as bad as the headlines have suggested, but neither is it good enough that you feel comfortable cutting as soon as the summer. And I think that's the quandary in which they find themselves.
Can you tell us what you've been doing in credit recently? What's activity been like?
Yeah, listen, the credit markets have been strong. I will say, as a traditional high yield distressed manager, there hasn't been as much distress, and you might not be surprised to hear that there aren't too many defaults, aren't too many of those bankruptcy situations, given how strong the economy has been. There have been, of course, one-offs here or there, but the default rate remains pretty low. So across credit, it's a lot of rel val. It's a lot of finding thematic trades, not dissimilar to what you see in the equity market. But I have to say, we're spending a lot of time in the equity market. The returns potential seems more attractive to us on a relative basis.
Interesting. Why?
Well, for instance, we've been pretty optimistic on the energy space. As a fund, we've been pretty optimistic on the energy space. And from a return potential standpoint, it's been more attractive to be positioned in equities across the capital, across the market cap spectrum, as opposed to the credits. Now, mind you, again, energy, distress, high yield, not really a thing anymore because we blew up the entire space and restructured and merged, et cetera, et cetera. So to get yield, so to speak, dividend plus buyback, et cetera, you can do pretty well in the equity market, and I think we've been pretty happy with that performance.
We'll have a conversation with Amanda Liner of BlackRock, a little bit more detail on credit later, but can you just describe some of the price performance, the price action within high yield? We've been looking at spreads still super tight. Are the lower quality credits being left behind? Are there some worries about the ability to refinance later this year, going into 25, if rates stay at these levels?
No, from a performance standpoint, lower credits have done better. And again, that's commensurate with the risk-on environment that you've seen in equity, although in equity, obviously, the higher credit, so to speak, the large cap equities have done the best. But you've seen spread compression, you've seen outperformance on the part of triple Cs, double Bs, et cetera, which again speaks to the broader economic environment, which has held in there, but also the quality of the high yield market. This is something that I'm sure you've talked about with any high yield manager who's come on here. The market is just, this is not your mother's high yield market. Not that my mom was in the high yield market, but it's a much higher quality market from a rating standpoint, from a leverage standpoint, from a cash standpoint. Everything about the market is better today than it has been at most periods throughout history. And so when people say, oh, look at the high yield market, it's telling you X, Y, and Z, it's very hard to do that comparison to history. Not dissimilar to what you see in the equity market, given the size of those large cap names.
To put on a bow on it, are you willing to say that right now all the people who are saying that this is a golden era for credit, at least in the public space, are wrong, and that actually equities hold a better risk-reward kind of value? Or are you just saying that in specific asset classes, like within the industry of energy, you're seeing better value in equities?
I look at things thematically. It's a joke almost at this point to say it's the golden age of private credit, but in some respects, it has been a golden age for risk assets. And I think that's borne out in the data. It's borne out in the performance. You do have a robust economic environment. The consumer has been quite strong. All of this is incredibly surprising. No, I don't think one asset class is necessarily more attractive than another on a permanent basis, although typically, obviously, higher risk assets generate higher reward over time. But I think at this moment in time, for the last, call it 2 years or so, on a risk-reward basis, on a relative value basis, we've just been finding more opportunities in the equity space. It's not just energy, it's a lot of consumer-focused stuff as well. I think one of the ways that we positioned ourselves a couple of years ago, there was all this focus on the dwindling excess cash in consumer bank accounts. That never made sense to us. The consumer always seemed very, very strong. And there was always this we were always waiting for the next shoe to drop, and the next shoe never came. And so we found a lot of beaten up leisure and consumer-focused names to be extremely attractive. And I think in a lot of respects they remain so today. I can't say specifically what they are, but I think there is it's not a secret, some of the things that I'm talking about, I guess.
We won't ask. Dan, this was great. Dan Greenhouse there, son of prolific high-yield credit investor and member of Solace Alternative Asset Management. Dan, thank you.
Thank you for having me, as always.
Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. 2 traders in Hong Kong have left SocGen. The French bank discovered perilous bets that went undetected by its risk management system. SocGen didn't lose any money from the transactions, but the trade could have costed hundreds of millions of dollars if there had been an intense market downturn. China's top climate chief Liu Zhongming is set to have his first official meeting with his U.S. counterpart. Tensions loom over issues ranging from chips to clean tech. Liu spoke with Bloomberg's chief North Asia correspondent Stephen Engel in Beijing.
That's one of the worry in this climate change community. I definitely hope that the American people will support the government to stay in the climate change process, stay in the Paris Agreement, even Trump wins the next election.
Treasury market fragility is only going to get worse. That, according to a new report from Barclays, with more frequent bouts of illiquidity, poor functioning, and heightened volatility. It's the continuation of a trend underscored by the COVID-induced dash for cash. Several things are going to make it worse this time around, including increased Treasury supply and complex dealer constraints. The strategist writing, quote, "The substantial supply of Treasuries means that regulators and investors are fighting an uphill battle." That's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. We'll catch up with Danny in about 30 minutes' time. Up next on the program, Tesla's bumpy year.
Elon Musk saw an opportunity to go in there and say, look, I want to do this because you've seen the clashes that have been going on between the U.S. and China. He's trying to put a foot in both sides. To me, this is a way to say, I'm going to change up this math for myself.
Why more job cuts could be just around the corner. Live from New York City this morning. Good morning.
Wednesday, the Fed decides.
Jay Powell pumping the brakes on rate cuts.
Hikes are off the table. No cuts looking perhaps a little bit more likely.
You can't say there's a whole lot wrong with the U.S. economy.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Our policy rate is likely at its peak.
The threshold to cut rates is a little higher.
We're redefining patience.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Equity futures on the S&P negative here by 0.05%. In the bond market, yields higher by a single basis point. On a 10-year, 462.81. Under surveillance this morning, Tesla's bumpy year.
Elon Musk saw an opportunity to go in there and say, look, I want to do this because you've seen the clashes that have been going on between the U.S. and China. He's trying to put a foot in both sides. And all of a sudden, the EVs in China started to get less expensive and Tesla started to lose share and he had to drop prices. So to me, this is a way to say, I'm going to change up this math for myself. But also, if I can be successful in this, then maybe I get to be the outlier.
So here's the latest right now. Fresh off a breakthrough for its self-driving unit in China, Tesla is said to be considering more job cuts, with 2 senior executives set to depart the company. According to the information, CEO Elon Musk will dismiss everyone working for those executives, with only a few set to be reassigned. Bloomberg's Craig Trudell joins us now for more. With that stock down 1.8%. Craig, what exactly do you think is going on?
Yeah, this is a report by The Information. We should credit them for this information, I guess. The 2 executives that they're getting rid of the 2 that are most interesting to me is the executive who was in charge of their supercharger team, because this is really a sort of crown jewel within Tesla. This is a company that really has prided itself on not only making electric vehicles that people want to buy, but making the infrastructure that's going to sort of facilitate interest in electric vehicles beyond just early adopters who are willing to try out something new and, cope with experiences of having to wait for a plug. I think it's also just really interesting timing in the sense that, in the U.S., the rest of the industry has really embraced Tesla's charging standard that they've tried to sort of make a certain their proprietary plug open to the industry and get everybody else on board with, changing their plugs to fit with Tesla. And then, the rug is seemingly being pulled out from under the rest of the industry in the sense that the person who was leading a 500-person team, according to the information, is gone along with her entire team.
Well, the rest of the industry is struggling. I'm just going through the numbers that you've been going over this morning in Europe. Mercedes first quarter earnings down by about a third. Volkswagen earnings down by about 20% in the first quarter. Craig, are they struggling with the same issues that ultimately Tesla's been struggling with over the last few quarters?
I'd say yes and no. I think that it is absolutely the case that, the higher borrowing costs that, Elon Musk has cited over and over again as the reason for their slowdown is certainly being felt by the whole industry. And I think we are just in a sort of new era of, back when the chip crisis was really restricting these companies' production, they had more demand than they were able to meet. That is over. We are now in a situation where everybody is producing more cars than they have demand for. That's going to mean pricing pressure, and we've seen that more acutely with Tesla. That's where I would draw the distinction, where EVs in particular, I think, have had a much more substantial come down in price that has hurt Tesla more so than it has damaged the rest of the industry.
China seems to be the juggernaut here. I mean, they're the ones that are producing electric vehicles more cheaply and more rapidly than anywhere else. How important is it for Tesla that he got this at least tacit or in principle approval for its driver assistance system to be deployed in China? What do you make of this? That essentially you've got Elon Musk kowtowing to Xi Jinping because is that really the only way that this company can regain some of its clout?
It's a fascinating story. I think it was obviously a huge success in changing the narrative, right? We've just been, seeing, day after day evidence of this company's earnings, earnings power really falling apart. And we've seen, just in the last few weeks, Tesla cut pricing in China yet again. Analysts, casting doubt as to whether there are any earnings left for Tesla China and their operations. There is, some potential here to get more incremental revenue out of each car they sell, or even their existing fleet by getting people to pay for what they market as full self-driving, their driver assistance system. And yet, I think there are some real questions about, just how long it's going to take for that, sort of in principle approval to be, a hard and fast approval. There are questions about how much they're going to be able to charge. I think just as there's pricing pressure for the vehicles themselves in China, I think, these driver assistance systems are now pretty common in China. And, other car companies aren't charging nearly as much for this functionality as Tesla has been charging for it in the US. So there's a real question of just how much of a revenue boost Musk may be able to get out of this.
Did he go to China for this reason? Because he also wants to show the United States he can get approval somewhere because he's having regulatory issues with FSD in the U.S.?
I think it's a great question. I mean, it is absolutely the case that he has been cozy with China going back many years now. This is a company that, was the first car manufacturer that was able to set up shop in China without having to establish a joint venture with a local car company. And that was a huge, red carpet treatment that he was able to get out of, the then, top person in the government in Shanghai, who is now the premier of Xi Jinping's administration. And so, for him to have really secured that, gotten all the help that he did during the pandemic, keeping that factory open, it has been such a huge driver of Tesla's success over the last few years. And this trip, seems to send a signal to Washington that, Musk remains very close with the CCP and is able to, get preferential treatment, or so it seems, that other automakers have not been able to pull off.
That stock yesterday was up by 15%. Now, Craig, a lot of people have got questions. Here's one. How can he maintain this relationship with China at a time when we're all expecting EVs to be getting tariffed pretty hard later this year? I'm talking about Chinese EVs coming into the United States. And if the former president becomes the next president, maybe those wars are going to be even higher. How sustainable is this relationship?
Yeah, it's a very valid question. I think we have to separate out, just how much the U.S. is going to go after Tesla's operations in China. It seems unlikely that they would, interfere with the company having some success in a foreign market. But I do think, to your point, there is a real question about just how willing and open Washington is going to be for, this to turn into a relationship where, say, CATL, the giant battery company in China, it becomes even more of a supplier to Tesla for the U.S., there's not interest in facilitating that.
Stock is down 1.7%. Craig enjoyed this. Thank you, sir. Craig Trudell of Bloomberg. I just wonder how welcoming Beijing will be when those tariffs start to climb. Coming up on the programme, we'll catch up with a story around Paramount, expecting to replace the CEO. That conversation up next. Big day today, this afternoon. Numbers from Amazon.
Thank you. That was great.
That's right. Thank you. I can do it again if you want.
Please.
Bramo says, watch out. Amazon later on this afternoon.
It's been a big
Apple
deal.
Thursday. I agree.
That's good. You're doing great.
All right. Thanks. Thanks for the encouragement. Nasdaq's negative by 0.1%. Russell's down by 0.4%. On the month, the Russell is down by more than 5%. Been brutal. Big repricing in the bond market so far this month. 2-year up by more than 30 basis points. 10-year up by more than 40. Up a single basis point on the session at the moment. The 10-year 462.81. Going towards payrolls. The estimate, sneak peek at a payrolls survey, Lisa. I'll give it to you right now. The estimate for Friday is for around 250, 240 now on payrolls, which is still pretty punchy, isn't it?
Yeah, although I do think there's more of a focus on what kind of jobs. I believe Sarah Hunt yesterday was talking about that it's not just a number. It's what quality of jobs, what that pay looks like. Could you see average pay actually come in? Because this is a lot more lower wage kind of employment. To me, this is the reason why it's going to be interesting to watch ECI today, coming out in about an hour, as well as JOLTS coming out tomorrow and a whole host of other labor market data.
Mike McKee's going to break that down for us in about 60 minutes. I'll throw in the ISM as well.
Yeah.
ISM manufacturing tomorrow, I think. ISM services on Friday. In some ways, might sound a little bit crazy, but sometimes the ISM services index has more potential to whipsaw this market than maybe even payrolls does on Friday.
We saw the S&P Global services index come in and actually surprise much more significantly than any of the data, or even what some people are saying about Jay Powell, who is going to try to be as boring as he possibly can tomorrow.
That's the big promo for our special Fed coverage tomorrow afternoon. Going to keep doing this, aren't we? Foreign exchange looks like this. Euro dollar and dollar yen. Take a peek. The euro at the moment just about unchanged at 107.21. The data out of Europe better. So the top 4 economies by GDP, Germany, France, Spain and Italy, doing better than expected. The euro can't really catch a bid, still in and around 107. This story's been wild, and I think we can just call it that. Dollar yen, 156.93. So if I told you 157 a week ago, you'd be like, wow, yeah, that's problematic. We were at 160 briefly yesterday. So this is still a problem for the BOJ, for the Ministry of Finance. Let's put it that way. How much of a problem it is, I don't know. The Ministry of Finance has been very, very vocal about this. The BOJ has been very quiet. And the BOJ seems to be satisfied, based on its communication, with where policy is and where markets are.
This is the reason why the market isn't really believing that they're going to intervene with any kind of conviction. And that's the reason why people are willing to fight the foreign minister and the sort of Ministry of Foreign Exchange in Japan, just simply because they haven't shown conviction. And we haven't seen that from the Bank of Japan either. Is it a victory for the yen to trade in and around 155 to 160 versus the 170 that some people were talking about earlier last week?
Well, let's see if this does settle down in that range. Dollar yen at the moment, 156.92. Under surveillance this morning, Secretary of State Antony Blinken urging Hamas leaders to quickly make a decision on Israeli conditions for a temporary ceasefire. While not disclosing specifics of the offer, Blinken said Israel had been, quote, extraordinarily generous in their proposals. We have talked about it a few times already this morning. There is plenty of speculation that perhaps we're closer to a deal than we have been in the past. We did have some comments from the Israeli leader about an hour ago, which suggested that the objectives haven't changed.
Well, this is the big question. If Israel and Hamas were able to strike this deal, and amongst my reporting as well as others in Bloomberg News, they are meeting today to discuss this in Cairo. You have the President of the United States putting a lot of pressure on Sheikh Al Thani of Qatar to get this done, of El Sisi of Egypt to get this done. But Netanyahu comes out this morning and says this: the idea that we stop the war before achieving all its goals is out of the question. We will enter Rafah and eliminate Hamas. So even if there is a deal, what does this mean for Rafah? That is still a question. Is a ceasefire just for a few months, or is a ceasefire actually mean a ceasefire?
There are many more questions than there are answers. I think that you really illuminated that well, and I think that that's something that Norm Roll was talking about earlier as well. We don't understand what that peace would look like, or that non-military action would look like at a time where there isn't a willingness for anyone to really step in and oversee it.
These are super serious issues. What's going on with the farce at Columbia University? What's happening with talks over there?
Right now, it sounds like there is a little bit of more action, in particular with one particular building.
Didn't they set a deadline?
They did.
Wasn't it 2 p.m. yesterday?
And some students were suspended, but then other students decide overnight, I think it was around 1, 2 a.m., that they occupied one building on Columbia campus. And I think at the moment, they're still occupying that building.
OK, we'll see how peace talks go over at Columbia University. I mean, it's a farce, isn't it? It's ridiculous. You've got serious issues taking place in the Middle East, and you've got this taking place up the road at Columbia University.
It doesn't really feel comparable, and yet it is actually one of the biggest political debates and one of the biggest political liabilities for Biden. And it really has raised a question a lot about universities as sort of the heartbeat of intellectual thought at a time where some people are arguing that there is not actually an exchange of ideas that's going on in an active way, but rather it's a lot of people who just are kind of hunkered down and not wanting to discuss it.
This is a difficult one for Biden heading into November, because you see these are the individuals, young progressives, potentially that would come out and vote for him. And this is another reason why, besides the dire humanitarian issue that the administration talks about happening in Gaza, but domestically, there's another reason why they'd want to get this deal over the finish line.
I think Mark Rowan of Apollo before Christmas absolutely nailed it before the turn of the year when he just said this is not about freedom of speech, it's about preferred speech. I think we've seen that on campus across colleges in this country repeatedly. Let's turn to the Federal Reserve. It is day one of a two-day meeting for the Federal Reserve. The central bank widely expected to keep rates on hold, but investors looking to Chair Powell and his news conference for a more hawkish tone and a possible pivot from the pivot, which is what Abramowicz focused on tomorrow afternoon.
Absolutely.
Elsewhere, upheaval at Paramount. Shares of the broadcast giant lower in the pre-market. The company replacing CEO Bob Bakish with a management committee. The trio of executives will lead the company as it negotiates a potential deal with independent producer Skydance Media. That news overshadowing a strong earnings report for Paramount, buoyed by the success of its Super Bowl broadcast back in February. Geetha Raghunathan of Bloomberg Intelligence joins us now. And Geetha was on the main event, the showcase, the big exclusive, the earnings call. Geetha, can you describe what happened on the earnings call yesterday afternoon?
Yeah, thanks, John. So this was, unprecedented, right? This was the shortest call ever, I think, that I've seen in the history of media earnings, about 8 minutes long. It was just bizarre, right? There was the management committee that spoke very briefly. Then you had, of course, the CFO, Naveen Chopra, come in and deliver the results. But there was absolutely no questions from the analyst community, from the investment community. So it was really more not what was said, but rather what was not said, which kind of tells us that a deal is imminent.
Can you talk to us about these new executives, the so-called management committee, this trio of executives? Geetha, who are they? And who do they represent? Because there were some reports that the former CEO wasn't happy with this deal that was on the table. Do we just assume that these three are happy with it?
I don't think so. I think this leadership committee is really just kind of a stopgap arrangement. It's definitely transitory. It's not the long-term strategic direction that Sherry Redstone is going to take or that Skydance is probably going to take. I mean, the three executives are really just the division chiefs at Paramount. So you have George Cheeks from CBS, you have Chris McCarthy from MTV and some of the other networks, and then you have Brian Robbins. So they've been leading, the different divisions. But yes, you're absolutely right. Bob Bakish vehemently opposed the Skydance deal. He protested against it with, Sherry Redstone, and obviously that kind of ultimately led to his ouster.
Should this make us more comfortable, Geetha, that this was an incredibly short call, that we don't have a clear sense of what's going on or how close they think that this means that the deal is, and that we don't have a sense of who the permanent leadership is going to look like going forward?
I think it's pretty clear at this point. I mean, there is this looming deadline. So May 3rd, which is this Friday, is kind of the deal. It's when the exclusive negotiating period between Skydance and Paramount ends. And so they're obviously looking to get something done right before that. Which is why you had that whole leadership change. They're working hard. Skydance came in, sweetened their offer a little bit. They're offering now $3 billion, a cash infusion into the company just to kind of assuage investors. And then it looks like Sherry Redstone has also kind of said that she's open to this majority of the minority vote, which means for the first time she's actually allowing kind of the non-voting shareholders to have a say. Again, this is all just a way to kind of appease investors who have been very, very opposed to this deal from the get-go.
Is there something that we can take away that's a broader kind of message in terms of what the successful media model could look like going forward from some of the messaging that we've seen? Sherry Redstone was concerned about Bob Bakish earlier just simply because he didn't sell Showtime and BET in previous iterations. The statement about these three in terms of streamlining operations and developing popular content, is this a matter of just simply jettisoning units that aren't as profitable? Is it about actually investing more in original content? Or is it just about being sold and being done with it?
Yeah, for Paramount, I mean, they have a unique set of challenges. And of course, it's emblematic of the broader media ecosystem, right? All of these companies were kind of faced with this really difficult challenge of pivoting away from their linear TV network business to streaming. Some companies could do it better than others. Disney, for one, has been, I think, fairly successful. Warner Brothers Discovery, again, they've had a fair amount of success. Paramount, however, hasn't really been that lucky. And that's kind of been one of the criticisms leveled against Bob Bakish, right? Yes, he managed to get 70 million subscribers on the Paramount Plus service, but it's come at a huge cost. The service has the whole streaming business has lost $5 billion since inception. And it's highly doubtful that it's ever going to be profitable. And so the question has been, should Paramount have even undertaken the streaming strategy in the first place? It's not the right strategy for everyone, definitely not for Paramount. They should have been kind of a content arms dealer. And that's kind of, a lot of the criticism against Bob Bakish for just kind of doing what everybody else was doing.
We're hearing a lot about Skydance, but what's the status of the Apollo bid?
So it looks like, I think Apollo is that there hasn't been any formal offer from them after that $26 billion offer, which was kind of, I think, soft and rejected by Sherry Redstone. I think they're waiting for this May 3rd deadline, and then they'll kind of come out with a more concrete offer. Rumor is that they're working with Sony to, again, lift that offer a little bit up from 26 billion to maybe 28, 29 billion, maybe even higher. There's nothing formal, so we don't really know the details yet. But I think we'll hear from them a little bit later this week.
Geeta, back to John's point, three feels like a crowd. Who holds the power in this troika of CEOs? At the head of CBS, Showtime, or Paramount?
I really don't think it matters. I mean, ultimately, the power is really held by Sherry Redstone. She calls the shots.
I think we've seen that demonstrated quite clearly in the last 24 hours. Geeta, thank you. Geeta Ranganathan with Bloomberg Intelligence. The biggest thing potentially happening in media in the last week or so is the most obvious thing that should have taken place a long time ago, which is the Super Bowl taking place on President's Day weekend. Roger Goodell proposing what we've all been saying for years. Why isn't it held on President's Day weekend?
Because some people who have to wake up early the next day cannot watch the whole thing.
Precisely.
And so this way, yeah.
The whole country can. Yeah. It's not just about me, Bramo. It's not just about you.
It never is always about you.
It's like all-day breakfast at McDonald's. It was like so obvious. Then Steve Easterbrook comes along. The Brit had to come to America, run McDonald's and say, OK, that makes sense.
Okay.
All-day breakfast,
really?
let's go.
Which is weird because you can't get all-day breakfast in the United Kingdom.
Okay.
This is like the all-day breakfast decision of the NFL. It's like so obvious. Just get it done. It's ridiculous.
What's the goal? To actually get more viewership? I mean, I think that they did pretty well. You think that they're going to get more
even
viewership?
more this way, yeah. Okay. The parties can go through the night and then you can wake up on Monday and do what you want. It's a day off.
Which is ultimately your ultimate goal because you're a party animal.
Absolutely. Big partier. I think everyone knows that.
Yep.
All right, including Danny Berger. Let's get to your Bloomberg brief. It's Danny. Hey, Danny.
I don't know what to say to that, John, but what I will say is I can check some earnings for us. Samsung up 1%. It's yet another case of AI-powered earnings. It topped earnings estimates. Its semiconductor division returned to profitability. Net income rose more than fourfold from a year earlier. Demand for chips used to develop AI has been insatiable, and Samsung says there are no signs it will let up this year. Now, if AI is one unrelenting earnings boost, weight loss drugs are certainly another. Eli Lilly shares higher by 6.6% in the pre-market. It beat and raised guidance thanks in large part to its diabetes and weight loss drug Zepbound. It also pulled in $517 million of sales for the drug, and it had similar success with its other weight loss diabetes drug Mounjaro. Eli Lilly shares have gained 26% this year. Now, Walmart is abandoning a plan to build out a network of low-cost health clinics. It cited escalating costs and reimbursement challenges. The company announced it will close all 51 health centers in 5 states and close its telehealth business. Walmart launched the initiative in 2019. As recently as last year, it had promised to open more than 75 centers across the U.S. by the end of 2024. That's your Bloomberg Brief. I'll send it back to you, party animal.
Danny, thank you. No one believes that. Everyone here knows I barely drink. First one in bed. It's like every night, 7 p.m.
This guy goes to a bar, sits there, and has peppermint tea.
It's true. That is a true story.
I know.
And at the White House dinner at the weekend, what did that? San Pellegrino with some lime.
Correct.
Then everyone kind of thinks you might be having a drink.
That was your goal?
Laid back Ferro.
Oh, yeah.
Yeah, right.
Getting wild.
Getting ready to be back on air Monday.
That's right.
With his voice.
Who was sitting next to me on the plane Sunday? Lester Holt, professionals doing the same thing.
All right.
You know, just pros, focused on having a good voice for Monday, for the audience. Hey, up next on the programme.
Some of us was asking the president questions and shouting.
Yeah. All right.
Yes.
Making the case for credit.
The case can be made that we're looking at corporates which are in better financial health than they have been historically. I think that credit definitely has a space in portfolios.
That conversation just around the corner, live from New York. This is Bloomberg. Equities right now on the S&P 500, negative by 0.1%. Yields a little bit higher by a single basis point, 462.40. Later on this morning, the ECI, Employment Cost Index, dropping at about 8:30 for the first quarter. Mike McKee's going to break that down for us a little bit later this morning. Under surveillance, making a case for credit.
In spread terms, we're looking at pretty tight spreads. Again, the case can be made that we're looking at corporates which are in better financial health than they have been historically. I think that credit definitely has a space in portfolios. Despite how tight it is from an all-in perspective, there is room for some credit in portfolios, I'd say.
Here's the latest this morning. Investors are waiting tomorrow's Fed rate decision. Expectations the central bank will keep rates higher for longer, fueling a search for yield and supporting demand for credit. BlackRock's Amanda Lynham writing this: policy normalisation in response to improved inflation is a supportive backdrop for credit. An extended delay beyond 2024 for rate cuts because of economic strength would likely be more easily digested by credit versus a postponement of rate cuts because of a sustained reacceleration of inflation. Amanda joins us now for more. Amanda, this is brilliant. Not all rate cuts are created equally. Not all delays are either. Is this a healthy delay?
Well, good morning. Thank you for having me. So far, it seems like a healthy delay because it's supported by resilient growth. I think the concern that we have is that the longer that these rate cuts are postponed, the more credence we get to the possibility of rate hikes. And that uncertainty around monetary policy is just not a great backdrop for credit. It's not a great backdrop for M&A or deal making. It's clarity on the macro that we need, not necessarily a favorable macro in terms of rate reductions. It's really that clarity that's key. So that's why we're focused on that.
What we've had so far this year has been a pretty resilient credit market in the face of a repricing of interest rates higher. What's behind that resilience? If you could go through the list for us.
Sure. So a couple of things. One is resilient growth. And I think that's been particularly important for speculative grade issuers that are more growth sensitive. So IG issuers have more of a cushion. They can handle a downturn in growth. High yield and leverage loan issuers, not the same defensiveness there. So growth is number one. Two is the yield backdrop. We've talked about this before. Spreads are tight, but yields are really attractive in the context of the post-financial crisis era. So if you're an insurance company, a pension, an endowment, you're looking for yield, it's been an attractive area to deploy capital into credit. But it's not been resilient across the board. I heard your earlier segment where you were talking about kind of triple Cs. It is true that triple Cs outperformed on a total return basis, but that's largely been driven by rates because triple Cs are less duration sensitive than, say, double Bs, that high end of the high yield spectrum. If you isolate credit spreads, which I would argue is actually the true measure of credit risk, triple Cs have been lagging. And so if you take the index level spread of high yield, 299, very tight, that would suggest that triple C should actually be somewhere around 600. They're around 720 in spread. So triple C's on a spread measure, which I believe, again, is isolating that credit risk, has not kept pace with the tightening overall. That's also true in the loan market where triple C's have lagged. So the market is efficient in telling you that not all of these companies can navigate high for longer the same way.
And it also expresses some concern about a lack of clarity around what the path of rates is going to be and how punitive that's going to potentially be for companies. Earlier
earlier this morning, we had Julian Emmanuel, who was talking about popping the question. And he was talking about how someone, maybe Michael McKee, is going to ask the Fed, well, under what circumstances could you imagine ever hiking rates, or is that off the table? Do you also think that that actually could really cause a massive dislocation in credit? If he answers, yes, we think that we could, under certain circumstances.
Right. So two things I'm watching for tomorrow. One is there an acknowledgement that we are at peak policy rates? It seems to me like maybe the chair wants to step back from overstating that emphasis like he has in the past. So that's one. Two is how patient will they be to get down to their policy objectives? So how many more months of this kind of middle ground of not sustained reacceleration, but also not declining inflation can they tolerate? So that's what I'm watching for tomorrow. As it relates to credit, yes, it will have implications, but I would expect that theme of dispersion, not widespread market disruption, to remain intact. One of the really interesting points so far this year is that over 30% of the defaults that we've seen in 2023, and this trend has continued in 2024, has been repeat defaulters. So these are companies that have previously filed and they're filing again, or they've previously completed a distressed exchange and they're doing another one. Why do I mention that? It's because a lot of these companies that are under stress are not coming as a surprise to the market, right? So long as we have this high for longer environment, what you would expect is that the same troubled sectors, capital structures that were kept afloat by low rates but are not actually growing in a capital efficient way would remain under stress. Does that cause broad market disruption in credit? I think the bar is still high for that. What could cause that is a sustained reacceleration.
Well, especially because Dan Greenhouse of Solis earlier was saying that basically this isn't my mother's high yield market, that this has changed, right? And that essentially we're looking at something that's grown up and become much better quality. Does that mean that the risk has migrated to private credit, where you have a higher degree of less tested companies?
I mean, actually, I don't think that the risk has migrated to private credit. I think in syndicated high yield, syndicated leverage loans, and private credit, you can find vulnerable companies anywhere. And in fact, what we're actually seeing is an overlapping of the addressable market between public credit and private credit, where companies are demonstrated access to both. I really think what it is that, say, take triple C's in the U.S. high yield market. This is using Bloomberg data. Interest coverage is 1.1 times. Just the margin of cushion to navigate a prolonged environment of high interest rates is very, very slim. And for most of the credit market, we don't view a 25 or 50 basis point rate cut as material or game changing in terms of their capital structure. But there are some companies where they actually do need that. And I think what the market is telling you is that on the margin, there will continue to be dispersion. I think there are some themes like the repeat defaulters that we've mentioned. Loan-only capital structures have also been leading the charge in terms of defaults, not surprising. So there are pockets of vulnerability that you can find, but I don't think that it's a wholesale shift in risk.
Could you give us some perspective on the all-in yield opportunity right now? How great is it? How big is it?
So on a percentile basis, using the post-financial crisis period, it ranks around the 80th to 90th percentile, depending upon the region and the rating that you're seeing. So what is that saying? It's saying that actually 80 or 90% of the time, yields have been lower than where we are now. On the spread perspective, it's the exact opposite, where we're kind of hovering around the 10% percentile. So basically, spreads have been wider than this.
So you've got to help me. Is it a good opportunity or not?
This is a great opportunity. So this is So maybe this is a little too nerdy for early morning TV. So yes, it's a great opportunity to deploy on an all-in yield basis, but we acknowledge that the opportunity for material spread tightening is pretty limited, just given that we're at 299. The post-financial crisis average for high yield is around 460.
Are you seeing equity investors migrate into your world? Because we had a guest, Lisa mentioned Dan Greenhouse of Solis earlier on the program, and he was talking about very specifically about energy. He thought, relatively speaking, the opportunity was better in equity than it was in credit. Could you describe maybe a similar dynamic?
I would say on the margin, we actually kind of see the opposite, where we see equity investors and I would say this is very on the margin, take some chips off the table after some pretty strong performance and deploy into credit to lock in some yields. But I would say the conversation can go either way. It really depends on what the risk tolerance is, where the sector focus is.
Appreciate the depth. Amanda, thank you. Thank you so much. Amanda Lyman there of BlackRock on the big opportunity in front of you right now, Lisa, in credit and the risks on the horizon, the companies who will struggle if we don't get that rate cutting cycle anytime soon.
I'll put some numbers on it. Basically, you could see high yield bond yields, all-in yields, below 4% back in 2021, 3.7% all-in yields. Now they are 8%, a little bit north of 8%. That is the yield. opportunity that people are talking about.
It's a massive, massive change. Third hour of Bloomberg Surveillance just around the corner. Coming up very shortly, Ron Temple of Lazard, Greg Valliere of AGF Investments, Robert Sorkin of Citi, and Anurag Rana of Bloomberg Intelligence. Anurag looking forward to the big earnings story. Of
What's
the
that?
week.
What's that?
Amazon
Yeah,
later
that's
on
right.
after
And then
the
on
closing
Thursday,
bell. Apple,
yeah.
two names making up 10% of the S&P 500.
Well, it's just the responses have been so violent after all of the earnings.
10% moves.
I mean, and these are massive, like $200 billion moves in market cap.
$2 trillion names just moving 10% in either direction on seemingly nothing. Tesla, another example of that yesterday, striking a bit of a deal with Baidu over in China, 15% higher off the back of that.
You know, I don't know what to make of some of these moves in any way, shape, or form, or the legitimacy of this. Do you think they're actually going to soften ties?
Don't know. Peter Chi of Academy said is 10% the new 1% for some of these tech names.
Well
Looking ahead
said.
to Amazon a little bit later. From New York, equities just about negative by 0.1%. You're watching Bloomberg Surveillance.
Mega cap tech just continues to crush it on basically every angle.
There's nothing wrong with tech. These companies have a ton of cash. It's just everybody's in love with them.
When you have these, powerful momentum stocks and growth rates decelerate, growth investors get angsty.
Earnings are earnings, and cash is cash. And so that is what people are looking at.
The Fed is in the rearview mirror. We're focused on other things. We are willing to trade rate cuts for earnings growth.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The week begins in 30 minutes' time. When I don't even really mean that. The ECI is important. It's just sort of not that important. The Employment Cost Index, 8:30 Eastern Time. Important enough for us to discuss. We'll do that with Mike McKee a little bit later on the programme. Far more important today on the schedule is Amazon earnings after the closing bell ahead of Apple on Thursday. And sandwiched in between, a Federal Reserve decision. The data just starts to heat up, an appetizer a little bit later on this hour. Then it's on to the ISMs, it's on to jobless claims, and Lisa, it's on to payrolls on Friday.
And it's really going to be how this comes together in terms of not just what that employment number is, but whether wages are reaccelerating, whether that confirms the 3-month reacceleration in inflation that we're seeing, and just how sustainable some of the strength and the inflation that we've seen really is.
Stephanie Roth over yesterday was on the program, and she actually was north of what the street is looking for jobs, 270,000 after we had more than 300,000 last month. To your point, how sustainable is this job market? I'm so keyed in on what it means about immigration to this country. How sustainable is that supply side when it comes to this jobs market, which is really keeping a lid on inflation?
Yeah, it's the compare and contrast, Anne-Marie. The compare between what is happening at headline payrolls and the contrast with what's not happening with wage growth. Wage growth is not running away, even though we're printing something above 200K seemingly every single month in this economy.
Which is a reason why Employment Cost Index, which comes out in less than a half an hour time, is so important, because that is one of the key metrics that the Fed looks at. And if you see it reaccelerating, then that gives you a sense that maybe the story of disinflation with employment gets really challenged in a more material way.
As I said, the week begins in 28 minutes' time. Equity futures on the S&P 500 look like this. We're negative by 0.1%. In the bond market, quite a repricing of the month so far, higher by more than 40 basis points on a 10-year. Some of that move fades just a touch, back down to about 462 on a 10-year. Bear in mind, last week, Lisa, through 470 on a 10-year. So we've had some big moves in April.
And it really raises this question in terms of conviction in markets and what's going to give a sense of what we can really depend on when you have these massive whipsaw moves in pretty substantial instruments. We're talking about the benchmark borrowing cost of the United States.
Yeah.
We moved yesterday on a refunding announcement from the Treasury Department that increased the borrowing by $41 billion more than people expected. The market moved on that. Even though that's a drop in the bucket when it comes to the overall Treasury market, it gives you a sense people are skittish. They don't really know which kind of frog to look at jumping.
Which frog? Okay, that's good. Laurie Calvasina of RBC yesterday saying that mega caps behave like small caps, and we've got Treasuries behaving like, I was going to say penny stocks, but apparently frogs. Coming up, Lazard's Ron Temple on tech earnings divergence. Citi's Robert Sorkin on his call for a July cut. Anurag Rana of Bloomberg Intelligence previewing Amazon earnings. We begin with our top story. Stocks heading for the biggest monthly loss since September, ahead of more earnings from big tech. Lazard's Ron Temple saying this: I still see upside for US equities, but will have to be driven by earnings growth from here. So far, the upside in the S&P has been narrow, but I expect the earnings growth to broaden out as we move through 2024 with better participation from other sectors beyond the tech and communication services and a Fab 5. Ron's with us around the table. Morning, Ron.
Good morning.
We're not talking about Mag 7, we're talking about Fab 5.
Yeah,
who did we drop?
Well, if you look at the year-to-date, basically Apple and Tesla have been a drag, even including yesterday's gains from Tesla. So really, it's the 5 stocks. And if I look at the earnings results so far this quarter, all of the earnings growth is 5 stocks again. So we're back in that story that we've had for the last 2.25 years, where the rest of the S&P 500 is really not giving us much to get excited about. But I think that's going to change as we move through the year.
What tells you it's going to change?
Well, part of it is I look at it and say the only way this demand for AI and technology investment can be sustained is if the customers get a return on investment. Companies aren't going to keep pouring money into these products and services unless they see some benefits. The key question to me is, how quickly do we see those benefits? Do they show up in the 2024 P&L? I'm a little skeptical. I'm hopeful on that front. But more importantly, I think as we start looking at the prospect of rate cuts, not just rate increases, interest expense will shift income statements in the market. And I think we're basically seeing an ongoing demand that's shifted from goods towards services, and that should also broaden earnings growth.
This was a story about 6 months ago, too, and a lot of people were talking about eventually we'd start to see things broadening out with rate cuts. And then it got pushed out 3 months, then another 3 months. Basically, are we in purgatory until we get the sense that the Fed is actually going to cut rates? And if they don't, you're not going to get a broadening out from the Fab 5 for the foreseeable future.
Well, I guess this is where a key underlying assumption for me is I'm still optimistic on the inflation front. I fully recognize the first quarter was an ugly surprise, right? January, I thought, okay, we can look at this and maybe it's a January anomaly. But we got February, and February was much better. But then March was kind of crushing in terms of that optimism. We had service inflation ex-shelter go from 5.1% annualized in the fourth quarter to 8.7% in the first quarter. Core PCE went from 1.6 to 4.4. I still think as we move through the year, you're going to see the labor market showing us an easing of tightness. And I think we're going to see that pricing pressure in the service sector start to ease. One of my favorite anecdotes, by the way, auto insurance has been basically 80 basis points of the 3.8% of core CPI over the last year. It's 3.5% of the index. Now, auto insurance rates are still going to go up for the next 6 months probably, but not at 22% annualized.
Steve Rashuda, though, of Mizuho would say you can cherry pick what you want. You still will have, you can get to 2% any which way. What would you have to see in some of the numbers that are coming out, starting with ECI, going to JOLTS that we get tomorrow, going to the payrolls report on Friday, as well as ISM data? What would you have to see to change your view?
Well, I guess what I would want to see, and back to the data this week, I think the ECI is probably one of the best metrics for wage growth. It's fully comprehensive, wages and benefits. It also works better in terms of adjusting for mix shift. If you look at average hourly earnings that we're going to get on Friday, that can be skewed. If you get more low-paying jobs, it makes wage growth look lower. So that one is probably less valuable. So on ECI, I want to see basically anywhere from a 90 to 100 basis point reading. It would be great if we saw something below that. I don't know if we see a 1.2, 1.3, that's going to spook the markets. I think if we look at the JOLTS data, questionable in terms of reliability. If you look at the response rate to the JOLTS survey, it's gone from 65 to 70% pre-pandemic to 30 to 35%. So some people do question if the data is reliable. I like to watch the quits rate within the JOLTS data. That tells you, are people finding better jobs where they're getting higher wages and they're moving? So it's another anecdote. And then on Friday, we'll wait and see. The market is saying around 240,000 new non-farm payrolls. We need about 130 to 140,000 in a typical environment to keep pace with population growth. If we get a big upside surprise and more positive revisions, that's going to make me a little more nervous that maybe this economy is reaccelerating. And by the way, if I take this alongside the data out of Europe this morning, upside surprises across the Eurozone, positive, albeit marginal commentary coming out of the Politburo in China. There is a risk that there's a reacceleration here and that would basically undermine some of my optimism on inflation.
To John's point earlier, so do you think Europe and China are catching up to the U.S. exceptionalism that maybe is petering out?
That might be a little too optimistic. I guess I look at Europe and saying going from zero to something positive is really great. But I do think there will be improvement this year. And I would also note, I think the case for the ECB cutting rates is a lot stronger. I mean, you basically don't have debating, and we're not debating whether Europe is reaccelerating. We're basically, it's clear that Europe's going from zero to something very low on growth. And inflation has been smoothly decelerating in Europe. So I think you're going to get 100 basis points of rate cuts from the ECB this year. And very importantly, monetary policy decisions in Europe have a more immediate and magnified impact on the economy than the U.S. because a lot more of the corporate rate is floating rate and a lot more of the household debt is floating rate.
So right now you're saying that your base case is you're going to get inflation coming in lower and you're going to get some rate cuts. What's the playbook if you do see that reacceleration in inflation and that case comes to play?
Yeah, if you get a reacceleration, then I think the Fed ends up keeping rates where they are. I don't think you're going to see the Fed raising rates from here. I don't buy into that hawkish thesis at all. I think 5.25 to 5.5 on Fed funds is plenty tight in real terms. And again, I appreciate the question, but when I look at the data, there's one part where there's a lot of uncertainty, and that's really the service ex shelter. If we look at the shelter inflation, we know from the Zillow Observed Rent Index that inflation there has basically declined sharply. It still hasn't shown up in the CPI, but historically there's a 1-year lag between Zillow and CPI and PCE. Based on Zillow, we know inflation for rent has gone from 16% 2 years ago to less than 3.6% for the last 9 consecutive months. CPI is still printing 6. So we know that part of inflation is coming down. We know core goods prices are still going to be soft because we can watch the Manheim Used Car Price Index. So when I piece it together, for basically 69% of core CPI, I know inflation is staying low or going lower. So I guess I have a hard time with the thesis that overall inflation is accelerating. I don't see that as likely. And I think we'd be better off focusing on what is the base case. We've gone from 9% inflation to close to 3%. There's been a lot of progress. Real interest rates are up a lot. And I think it's time for the Fed to basically start focusing on the other leg of the dual mandate, which luckily they don't have to worry about because the job market is strong. But if we can have a 3.5% unemployment rate and still get to the inflation target, that's how we should be thinking about later this year.
2 phrases I want to unpack with you. Plenty tight, plenty progress. Plenty tight. What evidence is there that we're plenty tight? And on the plenty progress, how much evidence is there that that's just a supply side story, not a demand one driven by the Fed, which you say is plenty tight?
I'm really glad you went there because I think one of the other things that's happened is we look at growth expectations in the U.S. The consensus for 2024, ECFC on your Bloomberg terminal,
I knew where you were going.
Is 2.4%. Just want to make sure I'm fresh. 2.4% for this year. If you go back to October, it was 50 basis points. So there's a lot of optimism around economic growth in the U.S. But there are signs of cracks. If you look in the consumer, mortgage and credit card delinquencies are up 40% year on year. Now, again, from a very low base. Auto delinquencies up 20%. In the Wall Street Journal this morning, there's another article about how many commercial real estate loans are coming due. The Mortgage Banker Association is saying $929 billion of maturities this year, $206 billion of which are office. You're going to see defaults on commercial property. We saw another bank failure in the last week. You're going to see more bank failures. There are going to be news stories that come through that start to chip away at some of this optimism. And so I think it's a little easy to get caught up in the excitement of current data and to say, what tightness? But the reality is monetary policy acts with long and variable lags. And I think we're going to see some of those lags come into play this year as the consumers depleted their excess savings, has trouble paying their debts, and as corporates actually find carrying these much higher interest expenses gets pretty difficult over time.
The short answer is wait. Ron Temple of Lazard. Ron, thank you, sir. Love a real-time conversation supported by Bloomberg and a terminal. We love that. Thanks, Ron. Let's give an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The ex-Binance CEO is expected to become the richest ever U.S. inmate. The crypto mogul known as CZ is facing sentencing today after pleading guilty to money laundering and sanctions violations. Xiao is believed to be worth about $43 billion. The DOJ, they're recommending a 3-year prison sentence. His lawyers, though, are arguing for probation, citing a lack of precedent for incarceration. Boeing has raised $10 billion yesterday in a bond sale. It will help ease some of their financial strains. It attracted $77 billion of orders, and that outsized demand was helped by Boeing dangling a relatively strong yield premium. It's also a sign that the U.S. credit market is wide open, despite a shift to price out rate cuts as insatiable demand for issuance continues. Goldman Sachs is in talks to transfer its General Motors credit card program to Barclays, that according to the Journal. It's yet another major step in Goldman's efforts to pull back from consumer lending. The investment bank's credit card unit had lost about $6 billion on a pre-tax basis since 2020. Barclays could strike a deal with GM as soon as this summer. The cards, though, have about $2 billion of balances outstanding. That's your brief, John.
Danny, thank you. I always wonder why this couldn't succeed, why Goldman couldn't come up with, if you think of sort of high-end luxury in the world of banking, you think Goldman Sachs, just in terms of the power of a brand. Why did they try and go mass market? Why didn't they sort of go down that road of getting high-end clients who want a credit card with Goldman Sachs written on it?
My gut is they're asking themselves that question in pretty significant amounts, given the fact that their consumer lending unit didn't do that well.
Right.
So you have to think maybe they were trying to broaden out so they could get that customer deposit base, essentially. They could actually move in to get some of the other business. They're probably
just never thought mass market Goldman just never worked, did it? From a brand perspective.
Which a lot of people, I think, would agree with you.
Yeah. Up next on the programme, working towards a ceasefire.
We are approaching an inflection point. The deal that is made involves a number of significant concessions, and it will have a ceasefire that in essence provides Hamas with a victory of survival.
A conversation just around the corner. Live from New York this morning. Good morning. Abramowicz got strong thoughts about domestic animals on farms. Now, if you're familiar with US politics at the moment, that's a top story. If you're not familiar, you probably think that's really bizarre, but knowing American politics, you'll guess that it's probably true. And it is. That is the top story in American politics right now. Equity futures on the S&P 500, negative by 0.1%. Wait for Abramowicz's thoughts. Yields just about unchanged, 461.58 in about 14 minutes' time. 13 minutes' time now. We'll get the ECI, Employment Cost Index. Mike McKee's going to break that down for you. Under surveillance this morning, working towards a ceasefire.
We are approaching an inflection point. The deal that is made involves a number of significant concessions. Israel has lowered the number of hostages it is seeking, has increased likely the number of Palestinians it will release, and it will have a ceasefire that in essence provides Hamas with a victory of survival. So the next few days will be quite important.
Well, here's the latest today. Israeli Prime Minister Benjamin Netanyahu vowing to launch an offensive in Rafah, quote, with or without a deal. Netanyahu's office releasing a statement saying the idea that we stop the war before achieving all its goals is out of the question. This as Secretary of State Antony Blinken is continuing his trip in the Middle East, stepping up efforts to secure a ceasefire. Greg Valliere of AGF Investments joins us now. Now, Greg, 2 hours ago, we were hoping that we were close to some kind of agreement on this ceasefire. And then that statement that I just read out dropped from the Prime Minister's office in Israel. What are the prospects, the chances of getting a deal today?
Not great, John. Good to see you. I think that we've got a ways to go. I think maybe Blinken was right. There were some generous parts of the deal, but Netanyahu is not going to sign off on this after going through all we've gone through in 6 months. So I think there's still a ways to go.
Well, if there's still a ways to go, what's the Biden administration's plan B, given the fact that we've seen a tremendous amount of pressure exerted by Washington to try to get this deal over the finish line?
Yeah, they'll just continue the pressure with Antony Blinken. But this is reaching a point where the political damage to Biden is significant. I think that you'd have to conclude, based on Biden's falling numbers among young people, that if the election were held tonight, Trump would win, might even win overwhelmingly. This is really worrying Democrats in Washington, who are concerned that it might not just be the White House, it might be the Senate and the House as well in jeopardy this fall.
You put out a note this morning going through potential VP picks for the former president. I actually wrote over the weekend about his meeting with Ron DeSantis. How difficult is it for Trump right now to shore up some of those individuals that DeSantis had in terms of the cash that he was able to bring in?
He'll get the cash, but I just get the sense, don't you, that the chemistry between DeSantis and Trump is never going to be very good. They just seem to be always at odds. But there are some intriguing names, and I think the number one name is J.D. Vance. He's red hot right now. I think he's the favorite. Elise Stefanik is high on the list. But I think you've got to say Kristi Noem is not going to be the nominee.
Okay, so I'm looking through your list, and I did notice she was the one you left off. Stefanik, Vance, even Greg Abbott gets a mention here. Kristi Noem, Greg, why did she do this? Why did she admit to killing a puppy on her farm?
I don't get it. Do you kill the family pet and then defend it as something, I guess, that shows she's tough and not going to back down? But I mean, this was really tone deaf, and I think that basically her political career has crashed and burned in the last 72 hours.
Yeah, you've never seen the left and the right unite under one instance recently than it has been when it comes to the governor of South Dakota. So let's talk about the actual potentials. Out of this list, who do you think Trump really wants to tap? Because also, the VP could potentially bring a voter base. Who would be the best in terms of trying to expand his appeal to the American public?
I would argue to expand his appeal, he's got to take another look at Nikki Haley. Wouldn't that be a story if he persuaded her to join? But assuming that's going to be too tough for him to do, he and Vance, according to the New York Times over the weekend, talk regularly. They've become very close. Vance, of course, as you know, a few years ago was a fierce critic of Trump, and now he's a big supporter. They don't need Vance for Ohio. I think the Republicans are in good shape in Ohio, but I'd put Vance as the number one contender right now.
Greg, do you have a sense, you're putting out this list of the top 10, we are in full-on campaign mode. Do you have a sense when the Trump team will actually come out and announce that pick? How long can they wait?
Probably until the day before the convention starts in mid-July. I think Trump is going to tease this. He's going to say, well, it's coming in the next few days, so stay tuned. And he'll just keep people on edge before he makes the announcement. I don't think he's picked anyone in his own mind yet. I think there's a ways to go that. And some people who need to get vetted, like Elise Stefanik, who most Americans have not heard of. So I think Trump waits until the very last minute.
There's also a question, Greg, and it goes on both sides, whether it's Republican or Democrat, which is, what is the mainstream for either of these parties right now? And it seems to be what both parties are trying to play with. On one hand, you have Donald Trump floating ideas of Fed independence and questioning all sorts of potential tariffs. And then you have, on the left, this question around what the protests on universities mean, how much that's going to be used by Trump against them, whether that's mainstream or on the fringes. Can you give us a sense of who the ideal Democrat is right now that represents the majority of Democrats, and who the Republican is who represents the majority of Republicans?
Well, I would say, obviously, Trump represents the clear majority of Republicans. No doubt about that. If you look at the polls, which have shown a little bounce for Trump in the last few days. On the Democrat side, it's pretty difficult to say. There are a lot of first-rate governors, Shapiro of Pennsylvania. There are several who I think would be intriguing and moderate. But the big political story to me is the polling numbers. And the polling numbers have taken a sudden dip for Biden. And I think that Biden and the Democrats are in real trouble right now.
Well, let's talk about that trouble, Greg. Some people are confident, Democrats constructive on this idea that there are independents, centrists out there that just haven't decided. And as we get closer towards the date, the president's pitch, it's me or democracy. Democracy's on the ballot. Let's make a decision. Let's make the right decision. We've heard that pitch repeatedly from the president of the United States. They think that ultimately the closer you get to November, the more it's going to land with independents and centrists, and they'll lean his way. Do you believe in that?
Well, we'll see, John. I mean, both of these candidates are infamous for their gaffes. There could be a big gaffe this afternoon. Who knows what we might see, or have Trump talk more about trying to control the Federal Reserve. So there's all of these wild cards that will crop up. But the one number two numbers have stood out for me in the last few days. Number one, young people turning against Trump, against Biden. If young people turn against Biden like they are right now, it's going to be hard for him to win because he's not doing well among Hispanics and African Americans. So he's got a big polling problem there. And I just think it's going to take a really concerted effort to see Biden pull this out, because the other issue is that more and more voters are saying under no conditions will we vote for Joe Biden. And the CNN poll that showed that was quite striking, that people are saying, no, there's no way in the world I could vote for him. Maybe I could vote for Robert F. Kennedy before I voted for Joe Biden.
Greg Valliere of AGF Investments. Greg, appreciate the update, sir. We'll catch up with you over the next few weeks. Should we get back to the book? Let's talk about the book. OK, so hardly any politicians write their own books. We know that. They sit around a table. Some people pitch them ideas. They might ask some questions and they'll go, give us an anecdote, just a little story of a time where you made a tough decision. Can you imagine sitting there and thinking, got an idea? This time I took the pet out to the backyard and shot it. And then they put it in the book, and all the advisors sat around the table and read that chapter and went, that's gold, that's going to land really well with the electorate.
You know, it would land even better if you took the goat out back afterwards, because it smelled like goat, and you shot that one too.
Oh, my goodness.
Cricket.
I mean, it is like, what are they thinking? Anyway, all right. You're going to see more gaps, no doubt, between now and November. Many more. Coming up next on this programme, Citi's Robert Sockin ahead of the Federal Reserve tomorrow and payrolls on Friday. ECI data just around the corner. They're still talking about the dog around the table. Hasn't stopped for the last 3 minutes. We're late to this story, you know.
Yeah,
I don't know why. I only just started discussing it. OK. Equities right now on the S&P 500 down by about 0.1% in just about 10 seconds' time. The employment cost index, which Lisa has promised is the most important economic data point of the week ahead, it drops in about 4 seconds' time. Of the day.
Yeah.
Of the day. OK, correction. Of the day.
Thank you.
ECI drops. Upside surprise. Told you it was important.
See?
Here's Mike McKee with more. Morning, Mike.
Good morning. Well, this is an important number because it's the wage and salary and benefit number the Fed follows the most, and it is up 1.2% for the month, for the first quarter, rather. The forecast was for 1% rise after a 0.9 gain the previous month. Wages and salaries increased 4.4% for the year ending in March of 2024, and compensation costs overall were up by 4.2%. That's a decline in those numbers, so it does show some progress, but again, this falls into the category of not confidence building for the Fed as they try to decide when they want to get to cutting interest rates.
Mike McKee coming in hot. So let's go through the boards together. Equities drop by 0.4% on the S&P 500. The opening bell about an hour away. As you might expect, a pop at the front end of the yield curve. We switch up the board and go to the 2-year. We're high by 5 basis points and back through 5% once again. On a 10-year up by 5 basis points. Remember, we went through 470 briefly last week, getting closer again at 466. On a 30-year high by 4 basis points at 477. The euro pulling back, a break of 107 again at 106.93. We're negative by 0.25%. And you probably all want to see what's happening with dollar yen, given the challenges that the Japanese authorities have had with that currency recently. That's broken back through 157 at 157.24, positive by 0.6%. So if you are just joining us, the employment cost index coming in at 1.2%. That is an upside surprise. The survey, the median estimate was 1% flat. Lisa, as you mentioned, the last big data point going into the Federal Reserve tomorrow morning.
This is really important because it challenges the idea of disinflationary employment. Yes, we're getting it at an aggregate level, but not necessarily when you parse through and weight things in a different kind of way. It shows that wage pressures are still there. What you see is that 2-year yield now back at the highs of this year, which really suggests the Fed's going to maybe have to have a more hawkish tone tomorrow.
Mike McKee, on Fed Day tomorrow, in hand, they will have not only this, they'll also have the ISM manufacturing number as well. I believe they will also have the ADP too, and they're going to have, Mike, a little bit more data elsewhere. Mortgage applications, stuff like that. Mike, how could this data change the conversations on the margin away from where we thought it was going only a week ago?
Well, I think it changes the conversation over a longer period of time. In other words, this shows that we are still seeing, as Lisa was talking about, wage pressures in the economy. They've come down a lot. They were up 1.1% in the first quarter of the year, and they had been up by a lot less, a lot more last year. But there is still pressure out there. ADP they will look past because everybody kind of does. They'll wait till Friday to see what we really get. The ISM numbers will be interesting. We'll see what the employment figures are, and of course prices paid. It's been going up. That's not something that they necessarily want to see as commodity prices rise a little bit. But it isn't going to change Wednesday. Wednesday, I think Claudia Sahm said it best. Jay Powell needs to keep his mouth shut, not say much, and I think that's going to be the bottom line for tomorrow's Fed.
Mike, what are you going to do if you ask him a question and he repeats what you just said because he watches this show?
I'll give him credit for that. Because,
you practice that.
If he says, I'm sorry, I've been told to keep my mouth shut, that'd be great, wouldn't it?
It's sort of a challenge when you try to keep your mouth shut at a press conference. I will want to say, Mike, there's been a discussion around a lot of the inflation rates that we've gotten in the first quarter, that they're skewed for a host of reasons, certainly on the insurance side of things, as well as a host of other metrics. With this employment cost index, is there anything that's technical about people getting wages in the first quarter or anything like that people are going to use to explain this away?
Not that I know of, and not that I've seen in the numbers so far. I mean, we've come way down the year-over-year rate, as I mentioned, for private industry, 4.1%. It was a year ago, it was 4.8%. So we're seeing 5.1% rather. We're seeing declines, but this sort of fits in with the narrative that we've seen over the last 3 months, that inflation has sort of flatlined. It's gone up a tiny little bit. Doesn't look like it's breaking out, but the story of continual disinflation has sort of taken a breather. And that'll be an interesting question to ask Jay Powell, is why do they think that is? And why do they think it might resume if they do?
Mike, stay close. Going to break this economic data down with Rob Sock and a City in just a moment. Mike McKee's going to be back in about 10 minutes' time with some final thoughts on this data. If you are just joining us, welcome to the programme. The employment cost index for the first quarter coming in a bit hotter than expected. It's been the general theme for inflation pressure through the first quarter, coming in at 1.2%. The median estimate in our survey was 1.0. The price action, the reaction to it, we're negative on stocks. We're down 0.4% on the S&P. On the Nasdaq, down almost 0.5%. The Russell down 5% on the month so far, and this morning down another 1 full percentage point and change. If you switch at the board and turn to the bond market, Lisa spotted this straight away. Yields breaking out back through 5% on a 2-year, up by 3 or 4 basis points at the moment. We'll see if this stuff sticks, but for now, this is the first move following this data from 5 minutes ago. We're up by 4 basis points on a 10-year, 465.71, and we're breaking out in the wrong direction for some authorities, including the Japanese Ministry of Finance. Back through 157 on dollar yen. We're positive on that currency pair now by 0.5%. Stronger dollar on the screen at the moment and a weaker Japanese yen. The dollar stronger against everything in G10. With us around the table is Citi's Rob Sockin. Citi's Rob Sockin joins us now, looking ahead to the Federal Reserve tomorrow and the data on Friday. Let's talk about the data that we just got. How much does that change things tomorrow?
This is a challenging print for the Fed. It's not quite a nightmare, but it's something akin maybe to a really bad dream. Coming in at 1.2 is just evidence that the inflation data, the wage growth data is moving in the wrong direction to be consistent with their target. And you already got a lot of hints of that with the Q1 inflation data. And, a saving grace may have been if wage growth showed continued signs of cooling on a quarterly basis. But I think putting all of that data together, it's going to be very hard for Powell not to lean a bit more hawkish into these figures and really say they're not seeing the progress on inflation that they need to be confident to start to ease policy.
This 1.2% increase in the employment cost index for the quarter was the biggest advance in a year. We're looking at a reacceleration at a time where even Citigroup, you believe that there is going to be a rapid deceleration and still a significant number of rate cuts later this year. Does this make you rethink that?
I think it's very challenging because, our base case has been based on a market slowing in the economy as you get later in the year. And that on its own would give the Fed more confidence that inflation would continue to cool. But you've seen the start of this year, GDP growth came in a bit softer than expected, but domestic demand was running near 3%. So I would call that a pretty strong economy. Labor market indicators are cooling, but still at pretty solid levels. And as I mentioned, the wage growth data are just not cooling enough for them that they can have confidence that the inflation moved back to target. So I think really the data, both on the activity side and the inflation side, are kind of moving against that.
There's also a challenge in this to the thesis that some of the employment numbers that have been really robust have been entirely driven by immigration, which has been disinflationary, and that we've gotten full employment without inflation. Do you think that these data that actually strip out some of the wage adjustments that we're seeing in some of the overarching payrolls numbers really presents a significant problem for that thesis.
Yeah, this is really key. We get a lot of data throughout the quarter on the labor market, on wages. It's really when you get to the employment cost index that's sort of supposed to be the be-all, end-all for wage growth. That is by far the best measure and indicator of wage pressures in the economy because, as you said, it controls for composition a variety of other factors. Now, it's not perfect. Maybe we are seeing some distortions in the first quarter due to bigger price gains and wage gains that are hard to seasonally adjust or control for. But this is supposed to be the one that the Fed hangs its hat on to tell it really where wages are going. So I do think this is pretty difficult news for them.
If wages are too high and companies are keeping up with these higher costs, could this spell then maybe layoffs?
Well, right now what we're seeing is labor market has been fairly strong in terms of hiring. Wage growth has been somewhat elevated. Inflation's falling, so real wages have been pretty good, and that's fueling ongoing strength in consumer spending, which in turn is fueling more strength in the labor market. And right now we're really not seeing much appetite for layoffs. So I think more likely is you could get an environment where the economy stays resilient, but inflation just stays much stickier than expected.
Mike McKee, we wanted to bring you back into the conversation on the labour market. Can we talk about some of the numbers we're expecting to get over the next few days? Tomorrow, ADP and JOLTS, Thursday claims, Friday payrolls. What are you and the team focused on?
Well, I think the Fed, and therefore me, are most focused on Friday's, payrolls, because that'll tell us something about how tight the labor market is and whether this wage pressure will continue. If we continue to get the same kind of job creation, it doesn't suggest any relief on the wage side unless there's a big addition to the labor force. So it is something the Fed is going to be watching. JOLTS was important, less important now. It's been coming down. As long as it continues to come down, number of vacancies continue to come down, the Fed will be less concerned about that. So I think it's really the payrolls creation number and perhaps wages and salaries within that that are going to attract the most attention from policymakers, unfortunately, after their decision this time.
Mike, go get a drink. It's good to catch up with you. Mike McKee there, breaking down the economic data going into the Federal Reserve tomorrow. Payrolls, in our survey, the estimate 240,000. Rob, you've got north of 200K on Friday. Where's that coming from, and why do you expect downside risk from here? What's guiding that view? I know it's a house view over at Citi. Andrew tells us it every time he comes on. Where's that house view coming from?
Yeah, absolutely. And we are expecting the labor market to still hold up well, as you said in this report. And the idea of the economy slowing is that we are starting to see in some areas a few cracks. In particular, if I was highlight on the labor market side, if you look at some of the small business indicators that we track, those are looking kind of worrying, especially in the survey data within the NFIB. That would argue that hiring is likely to slow a fair amount. That being said, as noted, the data have been kind of going against it in the first quarter, and we've seen upside surprises in payrolls throughout the first quarter, and over 200,000 in April is fairly strong number. So, that's kind of the basis for it. But right now, I think the labor market's been holding up fairly well.
There's been an ongoing debate through the show this morning about whether or not Fed Chair Jay Powell is going to be interesting at all, but also whether he's going to answer the question about whether a rate hike could potentially be on the table for any reason. You don't think it would be. You think that we're sufficiently restrictive. But do you think that this is a Federal Reserve that has to indicate some level of sort of, retracement from the pivot last year, just simply because you need an economy to run cooler with a market that really does sell off?
And this is a key point. And I think for the Fed, and you've heard Powell say something along these lines, they do feel they're restrictive. They would rather just hang out at these levels for longer than have to raise rates again. I don't think it's completely off the table. I think it would take something like an acceleration in inflation from where we are, and a continued acceleration through the year to really get that conversation on the table of raising rates. So I don't think he'll lean into it. I think he'll still say that they feel they're restrictive, but that they could hang out here for longer if they need to.
Do you think he's going to be boring, or do you think he's going to come out and try to make people feel a little bit more bearish?
I think he's going to be a little bit boring. I would expect him to come in and say that, not to say the Fed chair is ever boring, but that they'll come in and basically say that exactly as we're seeing that they don't have enough confidence yet. That the economy remains resilient. They do think inflation will move back down to target, but the data are kind of moving against that.
Would you like us to do a show tomorrow when we don't have to? We don't have to turn up.
Are you lobbying him or are you lobbying
No, just, for the people who make the promos who are in the newsroom, if you want to put that promo on a little bit later,
still newsworthy.
Just take the three guests we've had this morning that just say it's going to be boring and suggesting Chairman Powell shouldn't even speak. Robert Sorkin of Citi. Robert, it's good to see you. Thank you, sir. If you are just joining us, nothing boring about the last 15 minutes or so. Upside surprise on the employment cost index in at 1.2%. The estimate in our survey was 1%. Yields breaking through 5%. On a 2-year, again, let's see if that sticks. We're up by 3 basis points to 5.01%. On a 10-year at the moment, up by 5 basis points to about 4.66. Yields are up, stocks are lower. We're down about 0.4% on the S&P 500. And as you might expect, the dollar's stronger. We briefly broke through 107. We're back above those levels on the euro at 107.06. And if you're looking at dollar yen, which I'm going to do on my terminal, right now on the Bloomberg, dollar yen is back to about 157.32. So we've got a weaker Japanese yen and a stronger dollar. That stronger dollar dominating G10 this morning following that data. Let's get you an update on stories elsewhere. We can do that with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John, not unrelated. Ahead of Wednesday's FOMC decision, EM banks will be hoping for maybe not a boring Powell, but at least a dovish one, something they're unlikely to get, according to UBP's Peter Kinsella. Instead, EM central banks face a trade-off between cuts and currency depreciation.
You may see 1 or 2 rate cuts from various EMCBs, like Mexico, maybe Brazil, but really they're going to change their language, they're going to change their stance because they realize they need a positive real rate spread over US Treasuries, and as a result, there's a limit to what they can do.
Kinsella spoke with me earlier on Bloomberg Brief, which you can watch every weekday at 5 a.m. The race for NBA broadcast rights is on. NBC is preparing to bid about $2.5 billion a year to air the matches. That, according to the Journal. Games are currently broadcast by Warner Brothers Discovery. Warner was unable to reach a new agreement before the exclusive negotiating period closed last week. Amazon is also reportedly in the running to receive some regular season and playoff matches. But let's be honest, the Caitlin Clark matches are the most important. Elon Musk's wealth is on the rebound thanks to a surge in Tesla prices in the past 5 days. Musk's net worth gained more than $37 billion, according to the Bloomberg Billionaires Index. Off the back of news he had gained support for his driver assistance program in China, Musk added $18.5 billion to his fortune yesterday alone. With more than $201 billion, he's close to overtaking second place Jeff Bezos. That's your Bloomberg Brief. John.
Danny, thank you. Up next on the program, Amazon in focus.
Let's not forget, a big piece of Amazon today is advertising. It was roughly $50 billion at the end of last year. Be interesting to see how it evolves for this year. The strategy is keeping people on Prime.
Amazon results coming up after the close. That's a little bit later. Equity futures pulling back by 0.4% on the S&P as we close out a messy month of April. From New York, this is Bloomberg. Had some data about 20 minutes ago. A upside surprise on the employment cost index, 1.2% against an estimate of 1%. Marginal move lower on the S&P 500, down about 0.4%. Yields are higher by 4 basis points on a 10-year to about 4.66, up by just a little bit at the front end, but back through 5%, up by 3 basis points to 5.01%. With those high yields, a stronger dollar dominating G10 again. Dollar yen breaking out to 157.37 on that currency pair. At the moment on the session intraday, we are positive by 0.6%. Under surveillance this morning, Amazon in focus.
Let's not forget, a big piece of Amazon today is advertising. It was roughly $50 billion at the end of last year. Be interesting to see how it evolves for this year. The strategy is keeping people on Prime, is some sort of an upcharge as they add football. They've got a built-in audience, and the thing about that audience is they don't have to pay much to acquire it.
Here's the latest. Amazon earnings out after the closing bell. Analysts expecting a sales jump, joining its Mag 7 peers as the online retailer spends on the cloud and artificial intelligence. The results will also be the company's first since it introduced ads into its Prime Video service back in January. Anurag Rana of Bloomberg Intelligence joins us now for more. Anurag, looking forward to this afternoon when this number drops. What are you and the team looking for?
Yeah, the couple of numbers they're really focusing on is advertising as well as Amazon Web Services. I think these two are extremely important for Amazon's total profitability, and those are the numbers we're looking for.
What we've gotten so far from Microsoft and Google were really big beats on their cloud services, particularly some of the artificial intelligence that's being deployed through those offerings. How much do you think that that's cannibalizing from Amazon? Are we going to see a similar type of result from them?
Yeah, I think expectations for Amazon Web Services are very high right now. Now, there are two things to remember. First, Amazon does not have a Microsoft-like relationship with OpenAI where it can capitalize on the more, increased use of ChatGPT, for example. And the second thing is the size of Amazon Web Services is extremely big compared to the other two cloud vendors. So it's possible that they may just be able to either meet expectations or slightly beat them, and people may not like that. So that's going to be the biggest thing for us to focus on today.
What about when people are talking about China and advertising on U.S. platforms, that's a significant driver of revenue for the likes of Amazon? How much are you watching the potential retracement of some of that spending?
Yeah, I think for Amazon, they're taking market share away from other avenues because for a lot of people, they are going straight to Amazon and searching for products, and it gives them the opportunity to monetize on it. Over the last few years, that business has just gone from nothing to, over 50 billion at this point on a run rate basis. And, it's expected to grow this quarter, somewhere around 24-25%.
Seeing a lot of people talk about a potential dividend. Is that on tap today?
Yeah, I think there's going to be a lot of discussion around it, and probably, one of the very few companies that's in the large tech world that's not doing it. So I think it's possible, but again, it's very difficult to predict that.
Anurag, what's behind the recent move towards dividends of these mega cap tech stocks that we're typically used to delivering massive stock buybacks? But what's new about the dividend story? Where's that coming from?
Yeah, but what else to do with cash at the end of the day? You can't buy anything. I mean, you buy a tiny little company and the regulators are all over you. So either you buy back shares, which they all do, or at least most of them do. And the second area would be, give back money a little bit from dividends.
The politicians don't like the buybacks either, as we know. Anurag Rana of Bloomberg Intelligence, it's like lose-lose right now. We've got all this money. We can't buy anyone. Can't buy back our own stock. They don't like that. Yeah. So let's just introduce a dividend.
Basically, these companies have so much cash that they don't know what to do with it, that they're looking for ways to just be like, here you go, just get in a helicopter, throw it out the window.
Like Bernanke?
Yes. You get, an Amazon helicopter drop.
Why not? As I was saying at the top of the ad, the week would start at 8:30 Eastern time, and it did.
Right.
Week started 23 minutes ago when we got data on the employment cost index. Things start to get busy from here in all seriousness. We get the ISM tomorrow, the ADP report, whatever that's worth. The job openings report, which is still, Lisa, closely followed. You can talk about whether that data is good data or not. It is still closely followed. That goes into Thursday, jobless claims, Friday, the payrolls report.
Yeah, and a lot of people focusing on the quits rate in particular with JOLTS tomorrow. Here's the issue. The data has not been friendly to what the Fed has been looking to do. And I think that Rob Sockin actually put it really well when he said, it's not exactly a nightmare, but this is like a really bad dream for the Fed. It's going in the wrong direction. And this is the data point that it's hard to strip out and say, well, it's getting skewed because of this, that, and the other. This is something they've looked at in the past and they'll be looking at right now.
I'm so much more interested now in the jobs data on Friday. To your point earlier, Lisa, the fact that the supply side of the jobs market, immigration, this is supposed to keep a lid on those labor costs, and potentially it's not. We're starting to see that unwind a little bit.
That's a supply-side story that policymakers and investors alike have taken a great deal of comfort in. This idea that you can see numbers like this, 240, 303, and not get carried away about wage growth. And they're taking comfort from that. Now, whether you think as just a layman whether they should take comfort from that is a completely different debate. But that's what policymakers have taken comfort from.
And what this is the biggest jump in a year in the employment cost index. It's above anybody's estimate, and it comes as yet another hotter than expected surprise at a time when people are really holding their hat to that potential thesis, and it's proving it doesn't really last as long as people.
Let's go through the lineup tomorrow. So tomorrow morning we'll kick things off with Tony DeSpirito of BlackRock, Earl Davis of BMO, who's been phenomenal on the bond market so far. We'll speak to Deutsche Bank's Binky Chada and Jonathan Pingle of UBS. UBS have got some interesting views on the Federal Reserve and the path forward, haven't they?
Basically, if they don't cut and if the data does reaccelerate, they could see a Fed funds rate next year of 6.5%, something like that, that rate hikes for next year come back on the table. People are all over the map because you can't get any sense of what paradigm we're in. And that is a scary place for a lot of people.
You know, I know everyone spent the morning, particularly on this show, pouring ice cold water over Chairman Powell's news conference. I know I meant to say this, but I really mean it. I disagree.
I do too.
I think it's going to be quite an interesting news conference. You've had news conference after news conference where the Federal Reserve Chairman has been able to refer to these upside surprises as bumps in the road. Once you've got three, you've got a trend. It's very difficult to do that anymore. And I think what we've witnessed over the last couple of weeks, Fed officials start to think out loud about the prospect of staying on hold for a lot longer than they thought we'd need to, and maybe even consider the prospect of needing higher interest rates down the road. Now, I don't think higher interest rates down the road are a base case of anybody's on the FOMC, but often news conferences are most interesting about how the chairman navigates difficult questions, and that's a difficult question at the moment to navigate.
If it's boring, that will move markets tremendously. Get ready for a rip-roaring rally because this is going to be a Fed that's not trying to pour ice-cold water on that particular market action.
That right there is the Bramo promo for tomorrow afternoon. Live from New York City. Thank you for joining us. Have a wonderful day. This was Bloomberg Surveillance.